Flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills this morning. Let's get to the three things that you need to know today.
First up, U.S. stock futures wavering this morning after the latest read on the economy. Retail sales data for January falling by more than forecast for the month, marked by wildfires and severe weather. The value of retail purchases decreased by nearly 1% in January, the biggest drop in 2 years, while December data was revised to the upside.
Plus, President Trump imposing reciprocal tariffs on numerous trading partners to rebalance U.S. trade relations. The tariffs would be customized for each country, aiming to offset not just their own levies on U.S. goods, but also non-tariff barriers, and could take weeks or months to complete. The move is seen as a potential opening bid for negotiations.
And on the earnings front, shares of Coinbase falling despite the company reporting revenue and profit that topped Wall Street estimates. The crypto company saying revenue more than doubled for the quarter amid the return of retail investors. This year alone, shares are up 20%. Meantime, Moderna shares tumbling after the drug maker recorded another quarterly loss, aided by an unexpected charge for a canceled manufacturing contract.
Retail sales fell at a steeper clip than anticipated in January, while retail sales ex-autos posted a surprise decline. 9 of the report's 13 categories saw decreases in a month marked by wildfires and severe winter weather. Here to discuss what this latest reading tells us about the U.S. consumer, we've got Yahoo Finance's Josh Schaefer here. Josh, the newsroom was abuzz when we saw the numbers cross. Of course. We all huddled around your desk just to see what was going on. What did we ultimately find?
Yeah, so retail sales, as you said, declining at 0.9% in January. That's the largest decline that we have seen in a year. Also probably notable that what was also a year ago, January retail sales, what often happens in January, you have a little bit of a holiday spending drop-off, right? I think a lot of us might have spent more money on perhaps gifts or traveling or something.
Stop looking at me like that.
Over November and December, maybe we hit some shoe deals, Brad, and then January, we do a little bit less shopping, right? So to see a drop in January isn't necessarily surprising. Economists arguing you add in the severe weather, just kind of adds up to a print that makes a little bit of sense. Of course, it still is a larger drop than economists had expected. One thing of note is sort of with these releases, they are month to month, so they're a little bit volatile. Sometimes you see sales will dip significantly in January, then you get kind of a bounce back effect come February, so that will be something people are watching for here. It's hard to really make a trend out of 1 month of this data. You would need it to fall several months in a row to really say, okay, consumers definitely slowing here. But I think overall, what it does do is it is 1 month of data and it's 1 month of consumer spending that sort of indicates perhaps, at least per some economists' early estimations, maybe GDP will fall below 2% in the first quarter. It's a little bit hard to recover from this big of a decline. But again, 1 month perhaps does not make a trend at this point, just something that I think we'll probably have our eyes on. Doesn't look like the market is necessarily overreacting to this report either.
Well, it makes me wonder if the market is taking a note from Bank of America's Michael Hartnett this morning, saying that there's this idea that maybe the hotter than expected inflation data that we have gotten throughout this month is indicative that Trump might be handcuffed by the market because he's not going to be able to go full throttle on tariffs because those would also potentially be inflationary. What are you hearing from sources about the totality of those impacts on the inflation picture?
I mean, I think, Maddie, if you look at the overall market action this week and the market action that we've seen over the last 2 or 3 weeks, the market still does not believe that we are getting full tariffs, right? I think that's clearly what the market has shown us at this point. And I think to Hartnett's point, we've talked a lot about the different tools that Trump has and what he can actually do to sort of impact the market. Tariffs clearly would be one of them. And it doesn't seem like if that's going to stoke inflation, that would be something the president would want to do. Again, we heard from the administration, one of the key things they're watching is the 10-year treasury yield, right? Well, think about if he were to put full tariffs, we're talking about inflation, what's that going to do to rates? Likely moves your 10-year higher. We know the correlation we've been seeing with 10-year higher, that likely means stocks lower. So if he can avoid doing that, that would seem like a likely option at this point. But again, remains to be seen a little bit, of course, on the tariff front. Seems like we're getting a new headline on that every 30 minutes or so. So perhaps something will change while we're sitting at this desk today. But for now, seems like it's delayed, and the market doesn't really trust that the full tariff, the full Trump tariff plan is ever really coming, at least at this point.
Right, and the market also anticipating that the Fed is going to kind of sit still until it sees what the impacts of tariffs are on the economy and where that puts them towards that 2% goal that they've been crystal clear about and reiterated time after time again to this juncture.
Yeah, and then you wonder, Brad, we talked about one bad month of retail sales. If it continues, how more complicated does this Fed conversation get, right? If you had something like employment starting to slow a little bit more than we thought, and you have a little bit more pressure on sort of the Fed's other side of the mandate, perhaps maybe that's a conversation that comes into play too if we continue to see some weaker economic data like this. Weaker economic data has largely not been a part of the story we've been talking about for the last couple months.
Absolutely. Josh, thanks so much for breaking this all down this morning. Appreciate it. On Thursday, President Trump laid out his plan to impose reciprocal tariffs on all foreign nations, saying he wants a level playing field between the U.S. and its trade partners. At a press conference, the president called his plan simple.
I have decided, for purposes of fairness, that I will charge a reciprocal tariff, meaning whatever countries charge the United States of America, we will charge them. No more, no less. In other words, they charge us a tax or tariff, and we charge them the exact same tax or tariff. Very simple.
So yes, in theory, the plan sounds simple, but reality may prove much more complicated and more expensive for American consumers as the effective tariff rate is driven up.
That's right. So the effective tariff rate, let's really break this down because that includes the tariffs applied not only to the finished products, but also every single individual imported input, like the raw materials used to make that final product. So take, for example, a finished product like a car. Not only would the final product be taxed, but levies could also apply to products used in production, like electrical components, metals, and things like a literal battery itself. Once reciprocal tariffs are put in place, the effective tariff rate could increase as retaliatory measures escalate taxes on those individual components and materials. President Trump has also said non-tariff barriers, including subsidies, regulation, and value-added tax, will be considered when calculating retaliatory measures. So take the UK, for example. We're currently at a 3% tariff rate. Under the new order, taking into account regulation, IP, all those non-tariff barriers you see on your screen, that could land us closer to a 20% tariff. And that's where negotiations would start, at 20% versus 3%. So the tariffs could also hit developing countries particularly hard, given that they have some of the widest differences in tariff rates charged on U.S. goods brought into their countries compared to what the U.S. charges them.
So what does President Trump's latest tariff plan mean for the U.S. economy? Joining us now for more on this, we've got Wendy Schiller, who's the professional of political science at Brown University. Wendy, always a pleasure to grab some time with you. Let's start there. What economically is the pass-through here that we're anticipating, and over what stretch of time would that ultimately be seen as well?
Well, this is the big uncertainty that people are trying to sort of gauge. You know, what tariffs will actually hold. We had the president announce very large tariffs against Canada, Mexico, and within 48 hours, they didn't exist anymore. So this time, though, as opposed to the Trump 1, Trump 2 is using tariffs strategically, not just for economic goals, but for political and geopolitical goals. So fentanyl on the northern side and migration on the southern side, and he wants to claim victory. So what he's looking for from Europe, that's an interesting question mark. Is it greater contribution to NATO? Does he want to push them in other realms that aren't economic? And the other issue is what happens if the summer comes and there's inflation and there's layoffs and consumer goods are more expensive? That will hit the president's approval ratings. And even though he cannot run for re-election again constitutionally, cares a lot about being popular, so does his GOP allies in the Congress. So we're going to have to see whether he pivots, where he goes back and forth over the next couple of months, whether he edits the recommendations from the Commerce Department. But I think the American voter doesn't really think about this right now because it's not hitting right now. But we will see that it will hit. We've seen this before, and in particular with subsidies in the farm and exports. This really hits farmers. These are Republican states. So I think you're going to see a lot of conversation between the White House and the Congress in the coming months on tariffs.
Sounds like you agree with Michael Hartnett of Bank of America this morning, saying that rising inflation handcuffs the president's ability to go full throttle on tariffs, to summarize Hartnett's words there. Do you agree with that Trump will be handcuffed?
Well, I think it's sort of a dream signal to the White House, to the president, who rarely ever feels handcuffed, that we've seen. You know, he'll push the boundary. He'll use it to negotiate. And if you can give him a victory, he'll back off. And I think that's what people have to figure out in all these industries and all these trading partners. We are a global economy. There is no question about that. You can't just make one move and not expect ripple effects. But if you can hand Trump some victory, even symbolic, then he will back off. And I think that's what the markets and that's what international, multinational corporations have to do right now to give him something else that he can focus on.
Wendy, you mentioned something really key in that he's not going to be running for re-election. So approval ratings, all of the making sure that you're satisfying the base, it doesn't matter the same as it does for him, but perhaps for the party that he's representing, it does matter. And so all those things considered, who would he be trying to appease if he does go full throttle, regardless of what inflation is already doing?
I mean, I think what we've seen so far from this president, by the way, he can't really run. He can't certainly be elected or serve, but that doesn't mean he's not going to try. So I don't want to be on the record as saying he's not doing that. But I will say that he is basically exerting and flexing U.S. power. That is what he wants to do, domestically and internationally. He's pushing Putin to come to the table, theoretically, on Ukraine. He wants to figure out the Israeli-Gaza situation. This is his ambition, and his ambition feeds his desire, I think, to have a better approval rating, to be thought as a better president than the first time, and lay the groundwork for options should he decide to try to run again, even though right now he's constitutionally prohibited. So right now it's about him, and it's about what people think of him, and being a globally powerful leader. And that's where we've seen his sort of exercise of power much stronger in the early days than we did in his first administration.
And you can't really talk about tariffs right now without talking about tax cuts, because to a degree, Congress is factoring tariff revenue into that massive $4.5 trillion tax package that they unveiled last week. But Trump, he seems to be in negotiation mode, not in revenue building mode. If tariffs do end with concessions, if Trump gets a little bit from these countries and then backs off, is that a negative signal for tax cuts, which the market is very excited about getting?
Now, I think that Trump will do absolutely anything in terms of negotiation with the Congress to get his tax cuts. I mean, this, and Congress wants to do it too. They're all up in the House of Representatives anyway for re-election in 2026. They don't want to walk out the door without tax cuts. They all want it except the ones who care about the deficit. They're thinking about raising the debt ceiling by $4 trillion. And that's a pretty big credit card for the president. And thinking about debt, there's no way debt will go down. The national debt won't go down. They're not going to be able to cut enough spending in nearly enough time without harming the economy. We've just seen that even attempting to talk about massive cuts in the federal budget sends shivers through the economy. So, I don't know how you balance the budget here. You don't. So you incur more debt. Trump doesn't care about debt. He ran his whole life in terms of business on debt. So in that sense, he's not worried about it. He's going to put that onus on members of Congress, particularly in the Republican Party, who have been saying they care about it. But in the end, we'll pretty much have to vote to increase the national debt.
Yeah, well, ultimately, some of those debts led to falsified business records as well here, which we're convicted on. Wendy, thanks so much for taking the time.
My pleasure.
Coming up on Morning Brief, we dive into earnings and break down what's weighing on Moderna shares. Plus, we get the latest read on crypto demand as Coinbase reports revenue that more than doubled amid a return of retail investors. And we count you down to the opening bell on Wall Street after a tumultuous week for the stock market. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we're taking a look at Moderna, reporting mixed fourth quarter results, beating revenue estimates, but missing on earnings per share as demand for COVID vaccines weakens. This after the company slashed its 2025 sales guidance by about $1 billion in January. Joining us now, we've got Michael Yee. He was the Jefferies biotech analyst. Michael, good to have you back on the program with us. Just want to start off with your reaction to these results from Moderna.
Well, look, good morning. Great to be here. Look, Moderna remains in a very challenging position. We have spoken about this in the past. We downgraded this stock, I think, more than a quarter ago, talking about how revenue outlook continues to be very murky and the OPEX and spending continues to be so high and the cash burn is a problem. So the cash is $9 billion, going to $6 billion, going to $3 billion and downwards, and there's really no visible path to profitability that we would see on the horizon.
So if there's no visible path to profitability, Michael, then what does any potential bull case look like? You talk about a couple of potential positive catalysts, things like neurovirus, but it seems like that's a little bit more long-term. What would have to happen to get you to buy on this stock?
That's great. So look, there are 3 or 4 programs that people are watching that are in phase 3. Oddly enough, I think it's important that we mention today that while there is the Merck cancer vaccine, the phase 3 CMV vaccine, and the norovirus vaccine, the CMV vaccine has been delayed. The data has not hit, and they sound like they're pushing it out to later this year. And then on the norovirus vaccine, which is interesting, they announced a FDA hold due to a rare GBS event. So that was a big announcement this morning as well. So remains murky, but there are a bunch of things out there on the horizon that could be $1 billion. But I will tell you, we are cautiously optimistic at best on this.
What type of upfront capital expenditures are you expecting to bring some of those to fruition?
Well, look, the guidance that we see is spending $5 billion, $4 billion, $3 billion a year over the next few years. The question is, can the revenues get up from 1.5 to 2.5 to 3.5 to 4.5 to get them anywhere near that? So you're at this sort of trough level of revenues and at the peak of OPEX. And so they believe that they can get to profitability by 2028. We don't see that, hence the concern. And so that's the outlook. I think investors are probably figuring that out, but are still sleeping on it. And so, yeah, we still see downward pressure based on the outlook.
Michael, I want to switch gears a bit and talk about GLP-1s. And I know that you don't cover hims and hers in some of these names, but just broadly, how are you thinking about this administration's relationship with GLP-1s and specifically compounding GLP-1s and the availability of those cheaper compounded versions of these drugs to folks and what that might look like under regulatory pressure and how that could impact some of these stocks?
Well, first of all, we are quite bullish on the GLP outlook, particularly as it relates to Amgen, which reported great data. Lilly, which Jefferies has been bullish on, that's had a nice bounce. If you took a look at that in the last quarter, put up a good outlook. And so we definitely believe that there was a bit of a speed bump in the last quarter, and these stocks are going to rebound, particularly Lilly, Amgen, and some others. So we think we're still fairly early cycle there. In terms of compounding, we do agree that the agency is going to take a close look at this, particularly with FDA. And I know that Lilly particularly is working closely with the administration, the FDA, to get that shut down. So if that was going to happen over the next year or so, which we think is very possible, that would be another big catalyst to these stocks. And again, perhaps a concern for the compounders. So bullish on the GLP outlook, bullish on Lilly and Amgen and some of the small ones. And we do then believe that Lilly's working hard to get those compounders shut down.
And if shortages are ended by the FDA, is that also a benefit for Eli Lilly? Or do we know that consumers who get compounded drugs will switch to an Eli Lilly if the shortages are ended?
So 2 parts there. One is that the shortages, it has been removed off the FDA shortage list, period. The capacity and the supply from Lilly and others is generally there, particularly from Lilly. As it relates to whether people would swap, and there are estimates of, say, 10 to 20% or more of the market out there today is still compounded, that would be a huge positive tailwind to Lilly and others. So the numbers are a little bit murky out there. We do believe that a lot of them would switch, not all of them, because you can still pay out of pocket for some of the more branded forms. They're not compounded per se, but we do think that that is definitely a possibility this year, and that would be another positive catalyst to the GLP-1 branded stocks like Lilly and Amgen.
Michael, just lastly, as you're running the calculus across companies that are in your coverage right now, RFK, a net negative or remains to be seen, net positive for some of those names?
Good. First is that we have been calling for an RFK rally. That term relates to the Wall Street idea that these stocks and the XBI sold off dramatically since the election. If you go pull up the XBI chart since November and look at a lot of the big stocks, they have all had a pullback since November. We think a lot of this is typically more bark than bite. These stocks sell off, everyone's scared and worried, and at the end of the day, when he comes in, now obviously officially confirmed, that it won't be as scary as initially planned, and eventually these stocks move higher, particularly on fundamentals. So that is the idea. Overall, we do think that vaccines are going to be a particularly concern where you would not expect that to be sped up. You would expect that to be slowed down. That did come up today on the Moderna call. Secondly, we're a little bit watching Gilead, which is our favorite large cap stock. We've been raising the price target consistently over the last 6 months. Little bit concerned because HIV is a particularly sticking point with the RFK administration. Right. Regardless, we're watching it, but don't think that's going to be a big issue. Yeah. But really focused on vaccines. Otherwise, I think he's really going to be focused on food and nutrition, the other F of the FDA. So not too concerned about the biotech side.
Michael, one of the smartest voices that we've got on this sector. Thank you so much for joining us. Appreciate it.
Thank you for having me. Great.
Another trending ticker we're watching today, Airbnb surging after beating fourth quarter estimates. Revenue was up 12% from a year ago, boosted by growth in nights stayed. Still, the short-term rental company missing on first quarter guidance. Airbnb also saying it plans to launch new offerings starting in May. And Brad, I know you are going to break down all those offerings. What I really looked at immediately here is they talked about the potential currency volatility. You know, I love the geopolitical side of things. More than half of their revenue comes from outside of the U.S., so a strong dollar could be rough for Airbnb, but I know you got a lot to break down for us.
No, I think you started us off in a perfect spot, which is really the focus on international as they've continued to look across where they're bringing on more hosts here and really leaning into some of the most recent releases, upgrades to the platform. The 2024 winter release, one of those that they talked about, and the co-host network advancements that are helping personalize support based on host needs, listing setup as well, so bringing more booking opportunities online, which is key. But you know, as I think about a few of the areas that they're focused on within this kind of go forward strategy, especially as it relates to not just outpacing the travel industry's growth, which they talked about on the call, outpacing the travel industry's growth, revenue, nights book, and then gross booking value all accelerating in the fourth quarter of 2024. They think that growth is reflective of the significant improvements that they've made to the usability, the affordability, and reliability. And here's the point that is going to be sticky for a lot of consumers out there that are looking across all of their travel options. And at this point, anytime you do see a pullback, at least in sentiment of consumers, you typically see more of those consumers lean into areas that have massive rewards programs so that they could deploy points for their bookings and not have to come as much out of pocket. Remember, the travel industry relies so much on its profits because of corporate bookings. And so for Airbnb, they're really going to be looking across how they can bring on more of the corporate profiles, leveraging this as a supreme opportunity instead for their travel experiences, especially as they're leaning more into the night stayed, extending amount of night stayed as well. They're focusing more on those extended stays. That doesn't mean your weekend trip to the Poconos doesn't matter. It just means it's a little bit more profitable when they have PwC or insert consulting firm here renting out some type of place for a month versus just a weekend getaway.
It makes a lot of sense. Yeah.
So
really good point, Brad.
That's just a few of the ways to evaluate this name. Absolutely. We've been keeping tabs on shares. We'll see how they open up this morning. Also, we're keeping close tabs on this one as well. Applied Materials forecasting a weaker than expected second quarter revenue. The chip manufacturing equipment maker citing the threat of tighter U.S. restrictions on exports to China. Now, the company says export controls that were put in place during the final months of the Biden administration will result in a $400 million hit to fiscal 2025 revenue. Shares right now of Applied Materials are down pre-market by about 5%.
Yeah, it's really interesting to watch a company like this because they're a key supplier for companies like TSMC, Samsung, Intel. They use tools from AMAT to manufacture their own chips. They're also heavily tied to the overall semiconductor industry and global supply chains on semiconductors, something that came up on the call, export regulations as a potential headwind. I think it's just really important to take a look at AMAT because it is indicative of the fact that the chip sector has been significantly under pressure, and we're seeing the cycle in the chip sector evolving, and it's evolving in a direction that may be negative. Having said that, JP Morgan talking about how, yes, AMAT coming in modestly below expectations, particularly due to spending declines in China, which with tariffs coming in, that's only going to continue. But the company did report solid results, and its outlook does reflect the company moving away from China revenue and strong earnings power. So there also are some bullish calls still and reactions from analysts to this earnings print, but as you can see, the stock down nearly 5% ahead of the market open here. We're going to have all your markets action ahead here on Yahoo Finance, so stick around for more. You're watching Morning Brief.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
That's the opening bell that we're tracking up against here, just seconds away from right now as we're taking a look, hey, there it is on your screen, at Carman ringing the opening bell at the NYSE. And you got another opening bell, this time at the NASDAQ for Saturday Night Live here. And looks like Jay Farrow up there. You got some of the original, the OG cast members up there ringing the bell here. Oh my gosh, yeah, that is, I mean, anywhere you look, you'll spot somebody who you know from SNL from over the years there as we take them full screen. Taking a look at the major averages coming into the start of today's trading activity. The futures were pointing lower here. Despite the clapping and cheering, there's going to be some sad faces out there here today. But we've got a lot of time left on the clock as we're just beginning today's trading activity and taking a look at the Dow Jones Industrial Average, highlighting that's flat, just barely to the upside as of right now. And then additionally here, taking a look at the NASDAQ composite. Well, that's going to calibrate for us in a hot second. S&P 500 flat, just barely to the upside here. And then just going to load up a chart here for us as well, so you can see what the context is coming into the start of today's trading activity. S&P 500 past 5 sessions, you're seeing it net positive by about 1.5%. And then the NASDAQ NASDAQ composite. Okay, seems like that's calibrating here this morning. We're seeing that higher by about 1.5% to start off today's trading activity. Want to take a look at some of the sector activity as we begin today's trading session. 11 S&P 500 sectors. Got them pulled up here for you on the screen so you don't got to go looking for them. XLK, technology, pulling up the caboose. That's down right now by about 0.1%, but leading the pack out in front here in some Kelly Green. You're seeing that higher. Consumer discretionary by about 0.7%. We've got more Kelly Green on the table here than the red of the Chiefs, which are in decline right now and perhaps just out playing golf somewhere. But anyway, happy parade day to all the Philadelphia Eagles fans out there. And taking a look at the NASDAQ 100. We are seeing quite a bit of red here. Let's put this on an equal view just so you can see exactly where things are shaping up. More gainers than decliners here, leading the pack. Airbnb, we broke down those earnings here. Investors certainly catching a bid there this morning. And as I was trying to blow up that chart for you, ultimately the number says 13% higher. So trust me on that one. Applied Materials, we broke that down for you a hot second ago as well. You're seeing that start off the day lower by about 5% right now. Also, right next to them in some lake red, some maroon red, whatever you want to call it down for Palo Alto Networks by about 5%. For a deeper dive on today's early tape, let's get to Yahoo Finance's Jared Blickery for a look at what's moving.
Thank you, Brad. I want to start out with the indices, and I've been kind of hammering home how they have just been begging to break out. And this is the NASDAQ and as well as the S&P 500 that I wanted to look at. Let's put the 5-day chart on there. Well, it doesn't want to populate just yet, but suffice to say, a lot of these stocks near record highs. And so we had this bullish, we had a bullish reaction off of CPI Thursday morning, and it might not have seemed that way. However, it was a big day. It might have been Wednesday. That was discounting a lot of bad news, those higher prices. And what we saw was a reaction to the upside off of that. And so when we have a bullish reaction off of a potentially bearish report, that means I turn bullish. And let me take a look at the 10-year here. We'll see if we can at least get a quote. We can see that's down about 6 basis points, down to 4.46%. That is actually the biggest 2-day drop because it was down yesterday as well in about 4 weeks. And then just taking a look at the US dollar index, that has dropped to the lowest point in 8 weeks. You put all this together. So we have the indices like the S&P 500 and the NASDAQ very near record highs. Now we have the US dollar index dropping. That was a big headwind. That was a big concern when it was heading higher. It just kind of paves the way for a risk rally, a break to the upside here. So in the absence of catalysts, it looks like the next move is bullish, which is just a continuation of the short, medium, and long-term trend. Let's take a look at the sector action. Tech noticeably in the red, but not by a lot. Energy is leading, so are retail stocks. We got XLY, consumer discretionary, up about 0.5% there. I did want to focus on the NASDAQ real quick. Meta, I think it's every day this week. It has just been starting the day down and then climbing its way back into the green. Today would be an historic 20. I don't know of any other stock. You'd probably have to go into micro caps to find any instrument that has been up 20 straight days. So impressive there. And then futures. I'm going to close out with silver futures. I've been talking a lot about futures, gold, copper, and some others, coffee, and some streaks we had there. But silver today is breaking to the highest point that we have seen in 3 months. And let me get a price there real quick for you. Doesn't look like it wants to come up, but you'll have to take my word for it. Meanwhile, OJ futures down almost 5%, and coffee, which we were catapulting to record highs only days ago, that is in the red for about 2%, guys.
All right, Jared, thanks so much for joining us. Appreciate it. It's time now for today's strategy session. Inflation anxiety returning to Wall Street this week, but our next guest says despite the bad headlines, the price action is still strong. Joining us now, we've got Jay Woods, Freedom Capital Markets Chief Global Strategist. And Jay, I love the way you phrase this. The market's tough to read, but there are too many silver linings to ignore. What are the silver linings?
Yeah, the silver linings is price action. I mean, the headlines, the inflationary data makes us shake our heads and wonder exactly why we're staying at all-time highs. I think we were 3 points away from the S&P 500 closing at an all-time high yesterday. This is coming from someone that turned slightly near-term bearish at the end of December, seeing overall weakness. But when you look underneath the surface, the QQQE, which is the equal-weighted NASDAQ 100, we're up, we're at all-time new highs. The S&P equal-weighted is beating the S&P 500, which is market cap weighted. So we're seeing stocks rally, stocks that you don't talk about. No one's talking about AT&T at all-time new highs. Coke and McDonald's had great earnings on Monday, Tuesday, early this week. They're coming back. Disney, Starbucks, 52-week high. So there are some names that we've kind of forgotten because we're so focused on tech. But when you showed us that board earlier, all in Kelly Green except for technology, so a domination by Kelly Green, which is what, Eagle fans like us.
It's out for this week.
Yeah, this is a parade day. It all works out. But the point is, technology, which tends to lead the market higher, is falling by the wayside, and you have every S&P select sector up for the year, but the ones that usually lead are not. Financials doing well, that is important to the market. So I don't see us running away here to the upside given the macro backdrop, but we're treading water, and that's not a bad thing as we go sideways for a little while.
I mean, the long Mag 7 trade is already so overcrowded. Is it possible that we're seeing now for investors that are looking for other areas of the market to find value and looking towards some of those household names that you just mentioned, looking at everything from telecoms that are going to be needed, looking at those little luxuries in your coffee that's needed, looking at some of the major stays in entertainment, i.e. a Disney, needed. All of those things considered, it seems like these staples are being redefined here a little bit.
Yeah, there was a lot of concern with the strong dollar, and now the dollar coming in a little bit will help the staples. But we're going back to some boring names, and there's been rotation under the surface. I was just talking to Josh Schaefer outside. 48% of the S&P 500 is beating the average. 48% of the stocks within it are beating the average, but we're focused on those that aren't, like the NVIDIAs and the Apples of the world. This Meta run has been fantastic, almost 20 days. So we're seeing a little rotation within the Mag 7. It's not hurting the market as much as we thought. Look at something like materials. Materials, no one talks about, but the tariff talk has helped them. They were beaten down. I was looking at it as more of a mean reversion, but then when I looked under the surface before it came on air, so I didn't prepare you guys with any notes, but the XLB has a lot to reverse. It's starting to look good. Its main stock, 20% of it is Lindy. LIN is the symbol there. A nice little inverted head and shoulders bottom perhaps forming, and then the third biggest weight, Ecolabs, ECL symbol there, breaking out to all-time highs. So there is a lot of strength within this sector that no one talks about materials, but we're seeing a broadening out. I don't think it's enough to take this market much, much higher. And if we get a bad report out of NVIDIA in a few weeks, the 26th, I believe, then we could see the market turn lower, but we'll still see rotation, just not into the names that are really making headlines.
But I think about a category like materials, and then even what you mentioned, equal weight, S&P, for example. Tariffs has to come to mind. Like, do tariffs and potential policy implications come into play as potential negatives?
Yeah, but right now tariffs are just a fear factor. It's not a reality that we're seeing. It's being used as a negotiation tactic. And to the point, I forget what analyst said it, but with the CPI and the PPI numbers increasing, inflationary numbers increasing, maybe that is backing us away from increasing tariffs, because that would just put more kerosene on that fire. And I know Trump watches the stock market, so we'll see what happens with tariffs. But tariffs are that headline that keep us watching the tape back and forth, but it hasn't happened. And maybe he's screaming fire a little too often, and we're just forget about it.
Market is really ignoring the tariffs thing. It's fascinating to me.
It was the biggest fear coming into this year. It's been the headline mover. Let's see how we act on Friday. Fridays have been really bad. People have taken risk off going into the weekend. I don't think we're about to run into this market on a Friday afternoon and make new highs, even though we're so close. But if we do end this day at new highs, that's a breakout. That could lead to a little more near-term momentum. But it is a head-scratching market when you look at the macro data, and then when I look at price action is telling me we're not done just yet.
Yeah.
But will we take that euphoric leg higher?
Right.
Yeah.
Not so much, but if you're going to be somewhere safe, I think financials are still the way to play it. There are a lot of good names in that sector.
We only got 30 seconds left here. Do you think AI exuberance still has more legs to it, especially hearing how companies like Alibaba want to capitalize on the boom?
Without a doubt. In Alibaba, you look at charts on a long-term basis. I think Jack Ma is coming out of the woodwork too. If that breaks above 120 earnings next week, that has a lot to reverse. So yes, AI is going to be a theme. You had a new IPO IPO Pony, which is taking off, and then NVIDIA released their 13F, and they looked at different AI stocks that are moving as well. WeRide being the new one, Chinese autonomous driving. So it's going to move, but if you're trading these stocks, you got to be careful. Use stops. Be very on top of any trade you make with these AI stories that are, kind of smallish trades, if you will.
As Jay-Z once said, you could have been anywhere in the world, but you're here with us. We appreciate that, especially knowing you could have been at that Eagles parade today.
Not too late.
Thanks so much. It's not too late. Coming up, everyone, Coinbase shares falling despite a strong quarter. We break down what's weighing on the stock next on the Morning Brief.
Shares of Coinbase falling despite the company's fourth quarter earnings beating the street's estimates on the top and bottom lines. Revenue more than doubling year over year in the quarter, driven by Bitcoin's post-election rally. Citizens JMP raising its Coinbase price target to $475, also maintaining its outperform rating. For more, I want to bring in Devin Ryan, Citizens JMP Director of FinTech Research. Devin, great to speak with you. This is crazy. Revenue spiking 138%. For Coinbase, and I'm coming to you saying that the stock is down. What's going on?
Hey, good morning, Madison. Well, the stock did go up over 8% yesterday, so it ran pretty hard into results. It's up 50% since the election. So, I think it ran pretty hard into results, and you're just seeing a little bit of small sell-off this morning and kind of a little bit of volatile market. But the story here is fantastic, and obviously huge fourth quarter results. They gave some kind of early indication the first quarter maintaining that momentum. And when you take a step back, this is much more than about kind of what's happening in the fourth quarter or first quarter. It's about really the seismic shift happening in the crypto space more broadly, and how blockchain is now going to see a step function in adoption. And that's what gets us excited, and that's really driving our price target, not the fourth quarter results or even what's happening in the first quarter.
Devin, from Robinhood, we heard a lot about tokenization of private assets. To what extent is that a similar case for huge opportunity for Coinbase?
Yeah, Brad, it's going to be huge. And I think that's the big picture here, that you've had an industry that has really been held back for really the past handful of years here. And so what's happening is we're in process of getting to a point of clarity. You have the trifecta. You have a White House that's supportive. You have a bipartisan Congress right now that's looking to pass legislation. And then you have a regulatory backdrop where we're now finally getting to a point of clarity. And so areas like tokenization, areas like payments, remittance, integrating with Web3, and just integrating blockchain into the economy more broadly, we're finally getting to a place where I think companies that are in the space like Coinbase are going to be able to execute on the vision that they've had for many years. And that's what's exciting. But tokenization could be multi-billion-dollar kind of long-term opportunity for firms like Coinbase, in our opinion, as can an increase in stable coins, as can staking, as can all these other ancillary areas, which are not really even in results in a major way right now.
Is good news for Coinbase always going to be good news for Robinhood? And at what point does the success story for both of those companies potentially start to run into one another?
There is a lot of correlation right now, and I would say, obviously Coinbase is digital native and entirely focused on digital assets. And, I view Coinbase as really an infrastructure play on the growth in the industry. And I think people are getting it wrong when they think about competition entering, and that's a risk for Coinbase. It's actually exactly what Coinbase wants, because it validates that this industry is going to grow quite a bit. And they're really well positioned for that. Robinhood, on the other hand, I think is really, they've been held back on their offerings. So they've been very limited on the crypto assets, even for trading, let alone getting into all these other ancillary areas like staking and integrating stablecoins more deeply, and then tokenization and all the things that are coming with blockchain. So I think Robinhood, also sits kind of at the intersection of traditional finance and digital assets, and so they're in a great spot to be able to execute on that. And I think there will be convergence. Obviously, Robinhood is also buying a crypto exchange. And so on one hand, they will look more like Coinbase, but Robinhood is going in many other directions as well, with obviously trading of traditional assets and then getting into financial advice and other parts of financial services. But Coinbase will do similar, but as we tokenize and move stuff onto the blockchain, a lot of, I think, financial services will essentially merge with digital assets as well. And so that's our big picture of where we're going over the next decade.
Devin, while we have you, just wanted to talk a little GameStop as well. Taking a look at shares here, they are up right now by about 6%. That's off of today's session highs that we saw at the open, off of the back of earnings here. I wonder, as you're thinking through some of the investments that they're exploring reportedly, as well as what we at least heard through the earnings release, since this company won't give us regular earnings calls at this juncture, how you're evaluating the kind of future fundamentals as they can be analyzed at this juncture for GameStop.
Yeah, so I don't cover GameStop, but what I can speak to is kind of this idea of exploring digital assets and putting them on the balance sheet, which we've obviously seen. And I think you're seeing that now happen across the industry, and you're seeing positive reactions to that kind of this reserve treasury strategy. And that's a validation of the asset class, and I think something that both obviously drives adoption, and for firms like Coinbase that I do cover, drives trading activity and custody activity. But then also what we're seeing, and I think there's big conversation around a crypto or Bitcoin reserve, that drives price. And so we've done math on that, and we think that you could see, if you see these reserves happen and more adoption at the corporate level, and that could drive crypto market cap up by multiples from here. And that's what gets us excited, that you've got adoption occurring, but on top of that, the buying demand that didn't exist before is coming through, and that's very good for prices.
I guess just a quick follow on that. It seems like a page from the MicroStrategy playbook. If you can annex more of your balance sheet to crypto, then you're, a company that just has, in GameStop's case, a bunch of retail locations where you happen to sell games, but you want to be thought of as a crypto holder. How effective is that in terms of driving price for Bitcoin from this juncture?
I think you have to kind of differentiate between there's Bitcoin and then there's everything else in crypto. And obviously, Bitcoin is the largest asset, and I think has been historically the most stable asset. And so we're obviously more established ETFs and seeing adoption grow just off of the back of those items. And so I do think that we're in the early innings of seeing more reserves, whether it's at the governmental level across U.S. or other nation states, or even now companies as well. And so that is important to part of the price thesis. But that's not, in my opinion, really even priced in. A lot of that is, can this happen? And if it does, that would drive multiples of the market cap, as I just mentioned. And then, other crypto assets, we'll see. I mean, they all have different stories, and I think, obviously different arguments around the valuation. But I think part of this, my guess is for companies that are adopting a broader reserve, it's a view of having connectivity to this new technology and viewing it as a way to gain exposure to upside, in essentially assets that can beat inflation or beat other types of assets that you may hold in reserve. And I think companies have to think about the risk profile of what their treasury is going to look like as well.
Devin, great catching up. Great getting some of your analysis. Appreciate it.
Yeah, great to see you guys. Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. JP Morgan Chase CEO Jamie Dimon offering some candid thoughts about remote work during an internal town hall meeting in Ohio Wednesday. According to Barron's, in leaked audio, Dimon told employees he would not let managers have discretion over their team's in-office work. Dimon discussed how harmful remote work can be, saying he's been working 7 days a week since COVID. And quote, "I come in and where is everybody else? They're here, they're there, the Zooms don't show up, and that's not how you run a great company." Here with more, we've got Yahoo Finance banking reporter David Hollerith here. David, for anybody who's never heard Jamie Dimon speak before, some of the language, some of the way that he speaks might sound jarring, but for those of us who have heard him before, none of this is surprising.
Yeah, Brad, that's true. He hasn't used as many expletives when speaking publicly about return to office, but he's expressed a similar view. And the context here is that last month, JP Morgan Chase announced return to office 5 days a week for all employees. And at the time, about 40% of the company was working in a hybrid dynamic. And there's also been a petition since then from employees who are basically laying out a thesis for why they shouldn't have to return 5 days in the office. And the most obvious argument there is that for the past 2 years, JP Morgan Chase has set record earnings and profits. So, it's not going that badly, it seems like. Right. Obviously from this from this recording we can tell that Diamond's not having it. He basically said, screw your petition. We're going to do it my way. And what's really interesting about this too is, again, it's not about what Diamond said exactly as it is how he said it. He hit on a number of other topics, including spending initiatives related to DEI, and kind of went on a tirade about more generally the bank's potential waste and bureaucracy, and how he wants to cut back on that. So this kind of goes back to his chief worry, that is after 2 years of incredible profits. And he says this later on in the conversation or the talk, is that the bank could be losing its edge. And so he's coming in right now this week, and it's clearly a moment where he's this recording is sort of riding the zeitgeist, because it's got a lot of things going on in other parts of the world, like the federal government. Wall Street has obviously been focused on return to office and headed in this direction for some time, but this is really kind of hitting the moment.
Yeah, it's really interesting. He also talked about how it's hurting young individuals because there's not as much face time in the office, a lot of really important points, but the main one, get your butt back in the seats in the office. David, thanks so much for joining us. That does it for Morning Brief. Join me next hour for more analysis right here on Catalysts. Welcome to Catalyst. I'm Madison Mills. We are 30 minutes into the U.S. trading day. Let's get the three catalysts we're watching this hour. First up, we'll break down Trump's tariff plans and what it means for global markets. Plus, a check-in on the tech sector as Meta extends gains of its record-breaking run. And a check-in on the consumer as retail sales drop and inflation looms. All of that and more coming up on Catalysts. Kicking off the hour with a quick check of the markets following President Donald Trump's implementation of sweeping reciprocal tariffs. Taking a look at the major averages here, you've still got green across your screen. The S&P 500 up about 0.9%. We're really seeing the majority of the gains in the tech-heavy NASDAQ here, up nearly 1.4%. This is also interesting in the context of that retail sales data coming in this morning. A little bit disappointing, indicating perhaps some softness in the American consumer, but the market clearly looking past both that and any policy coming from the White House. This idea being that tariffs were not implemented today, so we're not going to worry about it today. Market sloughing that off. Really interested to watch whether or not we get a all-time high in the S&P 500. You can see yields continuing to come in. The 10-year significantly off of that 4.6% level we saw earlier this week, with yields down just a bit today and really across the board here. And finally, I want to flip the board over to Bitcoin, I believe. Actually, we're going to take a look at currencies. You still got that dollar weakness coming in here, which is really interesting given the strength of the dollar has been a challenge for a lot of the companies that we've been covering, even Airbnb out earlier. And you've still got some strength coming in those countries that will be impacted by tariffs. You've got the loonie there, the peso, and the euro all strengthening against the dollar today. Well, we're seeing a mixed picture for European indices after President Donald Trump announced reciprocal tariffs, which are set to be implemented as soon as April 2nd.
The European Union is wonderful. We all love Europe, love the countries in Europe, but European Union has been absolutely brutal on trade.
Joining us now to discuss the potential impact on global markets, Ed Al-Husseini. He is a global rate strategist at Columbia Threadneedle, and Jurrien Timmer, the director of global macro at Fidelity Investments. Thank you both for joining me this morning. Jurrien, I want to start with you. The market is looking past any of these potential tariff policy implications for now. What does this policy do to the current bull market that we're in when it is implemented?
Well, good morning. The market obviously has a lot of cross currents right now. We don't really know how much of these tariffs or threats of tariffs are going to stick. And in the meantime, earnings are very, very robust in the U.S. The economy is quite resilient. There's a lot of optimism right now about the length and strength of the economic rebound that happened since COVID. And so I think that right now is overriding the threat of tariffs, either raising in price levels or decreasing profit margins, because they would have to get worked through on one way or the other. And of course, the question of how much of these tariffs would be offset by a stronger dollar. And then on the other side, we have, of course, a very big debt situation, ongoing deficits. What does that do to the 10-year Treasury yield, which is right now at 4.5? Every time it starts to creep up towards 5, the stock market starts to wobble, and that's for very good reason, because Treasuries are considered the risk-free asset. And if the risk-free asset goes up in value or down in price or in valuation, it starts to compete with the risky asset. And towards 5%, that's been the case. But now we have, of course, the government efficiency, momentum underway. Again, we don't really know how much of that will stick, but that's providing some hope on the Treasury side. So all in all, the tariff question is really just one of multiple questions facing the market. And of course, we have the valuation question, we have the Mag 7 concentration. And I think for now, the market is focusing on earnings, and it's focusing on the 10-year Treasury being more better behaved in the face of the hope for less government spending.
Ed, what are you thinking about tariff and the impact?
Yeah, I mean, for me, the highest conviction view around tariffs is that they're negative for growth. They are ultimately a tax. They're a tax on spending. They're a tax on capital investment. And that is the first order effect that I'm looking for. I think secondary to that is inflation. It does cause a sort of a one-off, a temporary increase in prices. But I think from a market perspective, We're very used to, at this point, relatively elevated growth, and tariffs are likely to challenge that assumption.
And how are you thinking about the different growth impacts for different types of tariffs? There's the tariffs on something like aluminum versus the tariffs on finished products. Does it matter what the difference is in terms of the inflationary impact?
Yeah, I'll be honest, I don't know how to figure it out. There's so many different flavors.
That's important because the market also doesn't know how to figure it out. If you can't figure it out, neither can investors.
I think that's right. And one way to look at it is what is going on in aggregate in terms of the aggregate tariff or tax rate that we're applying to our imports offset slightly with dollar strength. And the net impact so far, we have had an increase in tariffs on metals, on China. The net impact so far is de minimis. The economy has not really felt it. But as the conversation heats up and eventually crystallizes into more tariffs, I expect to see that impact in growth first, and then we will start to think about what that means for risk markets.
And Yurian, let's talk to you specifically about that. What does happen to risk markets in this environment? Specifically, let's actually broaden and go to the global context here, because we've seen global stocks outperforming the S&P year to date. Is that a dynamic you expect to continue given the potential tariff impact?
So my main focus is the juxtaposition of how much of the bull market is driven by earnings. And of course, at the end of the day, over very long periods of history, earnings are the driver for stock prices. But oftentimes you will get that earnings gain amplified by increases in valuation. And so 2023, the first year of the current cyclical bull market, and 2024, both saw valuations really amplify, right? So in 2023, earnings fell 3%, but the market went up over 20%. That was all PE driven. In 2024, the market was up, more than 20%. About a third of that came from earnings. The rest came from valuation. So for me, the question is, can the market do a three-peat on having both earnings and valuation drive the train? And to me, I think it's very unlikely that that will happen. I think the earnings side is very robust. Fourth quarter earnings are underway. They're growing at 13% year over year. The outlook for 25 and 6 and even 7 remains robust as well. The typical earnings cycle lasts, 3+ years. We're only in the beginning of the second year. So I think we have room there. But as rates start to creep up, and again, that risk-free asset going to 4.5, maybe to 5, that should undermine the PE side. And then, of course, we run the risk that if the air ever comes out of the Mag 7, with the Mag 7 being a third of the market and trading at 40 times earnings, it's likely that the whole market would be under pressure, and that would be a scenario where actually the rest of the world can do better, at least on a relative basis, maybe not on an absolute basis.
Something else that's impacting the Mag 7 trade in the broader market is, of course, some of those other macro factors we haven't talked about, like the Federal Reserve. Ed, talk to me about those macro factors and what the monetary policy could potentially look like in terms of impacting the trade.
Yeah, I think the good news for investors is, at the moment, if you're looking at the Fed, you're very likely to see them stay on hold through the summer. So at least among all the moving pieces we have right now, it's a really decent assumption to look at the Fed and expect them to stay on hold. Now, beyond that, I think it gets really interesting. There are two tail risks around in this environment. One is the economy overheats. We have some negative supply side effects playing through, immigration, tariffs, and positive demand in the form of maybe perhaps additional spending, tax cut changes. If they combine in such a way that the economy heats up, similar to what we saw in 2017, 2018, then the Fed will have to consider hikes. On the other side, if tariffs are a drag on growth, as I expect them to be, if inflation continues to be relatively well behaved, we'll return to the cutting cycle. And the bet you're placing on the second half of the year is really which side do you think things will skew towards?
Right, and it's interesting to kind of monitor the moves in the 10-year and what the rates market is trying to tell us about what that might look like. Unfortunately, we have to leave it here, guys. So thank you both so much for joining me on our special coverage this morning of these reciprocal tariffs. Ed Al-Husseini and Yurian Timur, thanks so much. Let's turn now to how officials in Washington and business leaders are reacting to President Donald Trump's sweeping tariff policies. We've got AJ Dion Jr. He is a senior fellow in governance studies at Brookings. We also have Linda Yu, London Business School adjunct professor of economics. Thank you both for being here this morning. EJ, I want to start on this note we have from Bank of America, Michael Hartnett, saying that these inflationary pressures that we are seeing in the market right now will potentially handcuff the president's ability to go as far as he might want on tariffs. Do you agree with that?
Well, first of all, happy Valentine's Day to everybody out there. I think that the problem we have with judging what Trump is doing is that we don't know how what he says at a given moment is going to match what he ends up doing. And the market seems to have decided they're going to wait to see what he actually does. We saw with Canada and Mexico that he threatened these huge tariffs on a Friday, and by a Tuesday they were postponed. So first thing is we don't know where this ends up. But secondly, I agree with the danger that's being described there. These would be, Anna Swanson had a very good analysis in the New York Times that suggested these are the most sweeping. These reciprocal tariffs go way beyond anything Trump has proposed. They could blow up the whole world trading system. I don't think she suggested that. I don't think that's going too far. If he did everything he kind of threatened to do in that, we would be in a very new world when it came to trade. Tariffs obviously increase inflation to some degree. If we're lucky, we're saved by a change in the value of the dollar. Not all prices go up equally. But this is a big tax on what people buy, and that's a real problem for the broader economy.
And Linda, I want to go to you here because it's also a problem for companies. Talk to me about how you are thinking through the impact for earnings and therefore the impact to the market moving forward.
Yeah, it's absolutely a big issue for companies because this tax is being imposed on their final goods as they sell it into the U.S. market. So this is essentially an increase in production costs. And I think what's uncertain, and I think what you've just been discussing, is when it's going to fall and where it's going to fall. So for a lot of companies, if they're thinking, well, I've put my supply chain through, say, Mexico or Vietnam, which are ways of moving production out of China, those two countries have, they're in the top 5 in terms of trading surpluses with the United States. So if you're going to look for countries which run trade surpluses and goods, then I think it's going to raise challenges around how companies will organize their production, having already done so, spent money doing so, to move away perhaps from a connector country. So that's certainly one issue. But I suppose the overall issue, the problem for companies, is just that it adds uncertainty, and uncertainty deters action. Companies may hold off.
Yeah, Linda, I want to stick with you on that uncertainty because I wonder how you are trying to get clarity on what differentiates between tariffs that could cause a one-time price hike versus tariffs that could cause more significant and sticky inflation.
So reconstituting supply chains would actually be a longer-term uncertainty. So if we think that the U.S. in general just doesn't like unfair trade, and having a trade surplus is a proxy for that, then I think that could cause, higher costs for trade for several years. Now, if it's a tariff that's coming in because the U.S. wants to invite countries to negotiate, and it doesn't affect supply chains, so it's not targeting trade surplus countries, then I think it would be less sticky. But let me just say, reciprocal tariffs on countries that impose tariffs themselves, I think the Trump administration believes that value-added tax, so VAT or VAT, is an example of other countries taxing, being unfair in terms of trading with the U.S. That covers 175 countries in the world when you also include goods and sales tax. So that's nearly everybody. And that's almost unprecedented in terms of thinking about imposing tariffs by any country.
Yeah, it certainly is. And it also sounds like sticky inflation. So EJ, let me go to you. You have a line in your latest piece in the Washington Post. You say Trump has a, quote, obvious indifference to rising costs. He was elected by constituents who wanted inflation to come down. How are you squaring the difference between what his policies are indicating and what constituents elected him for?
I think that is going to become a bigger and bigger problem down the road if inflation stays where it is or goes up. We're seeing in certain spheres the price of eggs going way up, for example. And I think in his campaign, he said over and over, I will bring prices down on day one. A lot of the swing voters, not his base who would be with him in any circumstance, but the people who actually elected him by moving his way, were people who were worried about immigration. And we can argue, and I have deep problems with the way he's doing this, but that was one issue. But prices were his major attack line on Biden, on Joe Biden and Kamala Harris. And if inflation goes up, I think this will obviously give a political opportunity for Democrats to say all this crazy stuff you're doing with DOGE, all these tariffs are not doing anything about the problem on which you got elected. And so I do think this catches up with him politically, maybe not tomorrow morning, maybe not next month, but certainly by the time we have midterm elections in 2026. And so I think that is a big problem for him.
All right, E.J. Dionne Jr., thank you so much for joining us, and Linda Yu, thank you for joining us as well. We appreciate you.
Be with you.
Coming up, we're looking at today's trending tickers, with one tech stock seeing the longest winning streak in decades. We'll get you that stock after the break. Meta stock still on a tear after 19 days of consecutive gains. That's the longest winning streak for any current NASDAQ 100 company since 1990. The record run has sent Meta's market cap above $1.8 trillion. Joining me now to discuss, we've got Mandeep Singh. He's Bloomberg intelligence analyst. Mandeep, thanks for being here. I mean, Meta really on this record-breaking run. Tell me what this run is rooted in. What is it about, and does it have legs?
Yeah, look, I mean, when it comes to Meta, they own the distribution when it comes to social media. And, you know, the three apps, their core Blue app, Instagram, and WhatsApp, all have north of 1 billion daily active users. So when you look at the time spent on the internet, Meta owns a good chunk of it, along with, you know, YouTube and Google and all the other properties that Alphabet has. But what they have done very successfully in the case of Meta is apply AI across their apps. I mean, people talk about the ROI on Gen AI. Meta is one of the prime examples of how effectively they have added new tools to create ads using generative AI, to target ads using Gen AI. And that's why, all the infrastructure that they have invested in, the CapEx raise, is really translating into higher ad pricing and, better engagement on their platform.
Yeah, the overall stock market also owes Meta a thank you card because it's lifting the market right now, at least when it comes to the Mag 7. Take a look at this chart showing big tech market changes year to date. And you can see Meta, the obvious winner, Amazon coming in behind at a distant second. What does that tell you about the differentiating factors that are driving Meta's gains? You mentioned AI. Is that a story that you think is going to continue to allow Meta to outpace its Mag 7 peers?
Yeah, so the last, I would say, 12-month returns can be explained by the AI flywheel effect for Meta, as well as the year of efficiency that they started in 2023, and that really helped on the margin side. I think now the setup is slightly different in the sense that they've seen, most of the cost leverage, and now they're talking about raising the total expense guide for 2025. So I wouldn't be surprised if they have negative EPS growth, for the first 2 quarters. And so they're more relying on the top line, sustaining at least mid to high teens, and really controlling expense in the back half, which is not as favorable of a setup they had last year. But clearly, as long as they keep executing on the top line and, the AI flywheel is working, especially if WhatsApp takes off around search, and they've talked about how Meta AI has over 600 to 700 million users. If that really can be monetized, I think that's where investors will be excited about paying a higher multiple for Meta.
Also want to talk to you about this report from the Financial Times indicating that ARM is developing a new chip and that Meta is one of its first customers. What does that tell you about not only Meta's AI ambitions that you've been talking about, but also some of the potential beneficiaries of Meta's success?
Yeah, look, I think in the case of Meta, they're talking about spending $60 to $65 billion in CapEx for this year. I would imagine with all these hyperscalers, they want to develop their own chips. Now, we know Google has TPU, Amazon has Trainium. So Microsoft is also developing their own chip. And in the case of Meta, they were somewhat reliant on NVIDIA throughout in terms of, building this GPU infrastructure. So I'm not surprised they're taking steps to develop their own chip. And over time, if you look, 3 to 5 years out, they would want to, have their own chips for the kind of consumption they have in their own data centers and the apps that they have to support.
What's going on in the chip sector, Mandeep? Because I can even see it crossing right now, ticker symbol AMAT down after their disappointing results. I feel like the sector has been under pressure. More broadly, obviously, NVIDIA struggling year to date. What's going on with chips?
Well, so I think that's where the geopolitical element is quite important, because there is clearly a push towards U.S. manufacturing of chips from this administration. And if that were to happen, that kind of changes the supply chains for the way currently the chips are manufactured in Taiwan and, how they are assembled. And so from that perspective, I can see how it could disrupt some of the companies. And look, when these hyperscalers are talking about spending, the 4 hyperscalers are spending $350 billion in CapEx this year around data center build out. I wouldn't be surprised if they really ramp up their own efforts in terms of developing the chips in-house, which could have an impact on, some of the companies like NVIDIA and so on.
Mandeep, you always make us smarter. Thanks so much for joining us this morning. Appreciate it.
Sure.
It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. And I'm joined by Brad Smith to discuss these trending tickers. Brad is back with us. First up, Brad, we want to talk about Intel pulling back from its recent rally. The stock getting a boost earlier this week after Vice President J.D. Vance said domestic chip production is important to the Trump administration. But it is interesting, Intel still on track for one of its best weeks since the 80s. And that comes in the context, of course, as you can even see here on your screen, over the last 5 days, but much more broadly, if we can broaden that out, Intel has been under a lot of pressure just because of the transition to chips producers outside of the U.S. and, of course, NVIDIA, a huge beneficiary of that.
Yeah, domestic, internationally partnered chip production, though, is the reality of what we could see for Intel here, and specifically calling out from Citi their own evaluation of a potential foundry partnership that would potentially go forward between Taiwan Semiconductor and Intel. That surfaced, Citi ultimately kind of dissecting this, basically looking at three core reasons that this might not work out, or at least why it may fizzle here. One of them being staff members following commands of Taiwan Semiconductor. Additionally, the organizations and their production process ecosystems, which would require some major adjustments as well. And then additionally, finally here, the work culture variation. Intel staff members essentially kind of working under some of the same circumstances that the Taiwanese semiconductor employees are held to. And so those three things considered, reasons why Citi is kind of pushing back on this partnership, at least in the interim period of time. But for investors that have been watching Intel, no doubt hoping that they continue to catch a bid, at least in positive sentiment from the new administration, because the larger hang-up was the billions of dollars that were earmarked for chip production in the U.S., that there was a larger question mark as to the disbursement and the time scale for that disbursement once you change the guards in Washington, D.C., regardless of whether or not the PC demand cycle and the worst of that is behind us, which is what we had been really monitoring towards the third, fourth quarter of 2024.
It's so hard to look at the totality of the data coming in and the policy implications when you've got things like export controls, but then you also have tariffs that would be a negative indicator for names outside the U.S. Is that a lift for a name like Intel? If you look at today's trade, not necessarily so, as the street kind of looks past the potential of those tariffs amid negotiations. All right, finally, Roku surging after better than expected fourth quarter results. The company also forecasting strong annual revenue boosted by ad sales, but this is huge. Roku projecting their first full year outlook since 2022. That was a huge surprise on the call. They offered up this outlook for the first time in 3 years. JP Morgan saying it threw everyone for a bit of a curveball. You can see the stock rallying off of that, up over 13.5% here. The company projecting first quarter revenue of $1 billion, full year 2025 revenue at $4.6 billion. So that was in line with estimates. If you look under the hood, there were some parts of the print that were not necessarily positives, but I think that full year outlook catching the street off guard in the best way this morning.
Yeah, indeed. Roku kind of hitting the usher, watch this, right? Because they ultimately were able to deliver on some marks that not even analysts were anticipating they could top. I'm thinking of a few of them, three of them in particular here. One of them, the streaming households. You saw that reach 89.8 million. That in itself was a net increase of 9.8 million from 2023. Streaming hours as well. That was up 21.1 billion hours year over year. And get this, the average revenue per user was $41.49 on a trailing 12-month basis. That is also up 4% year over year, the highest mark that we've seen over the previous all-in 5 quarters that they've been reporting that metric, and really continuing to try and tell the street that it can extract more value from its users. And I think this also is a little bit more telling about where the direct-to-consumer entertainment environment can really continue to pull levers that Netflix has done so well and has gotten them into this echelon of being the North Star on the streaming front, and try to implement some of those either same pricing tiers and changes on the advertising front. That's going to be amazingly important for Roku as well. And then additionally, you think about the content that comes into the fray for a company in Roku that's really been looked at as the hub, which other content leverages in order for its distribution. Yeah. But now for them to perhaps develop some more of their own.
It's really interesting. It's another one of those companies that is benefiting from the consumer strength that is just not buckling no matter what the economy throws at folks. Reminds me of what Jay was telling us this morning. McDonald's, Coke, Starbucks, Roku, Netflix, all these consumer names that are staples that are not necessarily staples, becoming staples, and that is indicative of strength in the economy. Brad, thank you for joining us. We appreciate it. Thank you so much. Seasonally speaking, February does tend to be a tough month for markets, despite some of those good earnings prints from this month that we were just speaking about. Here with a look at how 2025 is going so far, I'm joined by market and data editor, also host of Stocks in Translation, Jared Blickery. Hey, Jared.
Why, thank you, Maddie. First, the good news. S&P 500 within an inch of a record intraday high. We'll get to the seasonality in a second. And here's the S&P 500. We came to 6127 and change. You need to get to 6128, but we're pretty close to that. And if we close at the current levels, that'll be a record closing high. We are in the month of February, and as you said, February can be a little tricky. And while we tend to end up, depending on how you slice and dice it, we are in the middle of a potential reversal. So this chart is February mapped out. This is 1950 to 2024, comes from Ryan Dietrich over at Carson Investment Research. And you can see we are right here, February 14th, and this is when the change in fortunes tends to happen. Now, I should mention that seasonality is only a tendency. It's what these price repeating patterns tend to do some of the time. It accounts for up to 1/3 of price action. So if there's a bigger swing in place, if there's a bigger catalyst, it can definitely be overridden, but this is an important backdrop to listen to. So this is a month of February, and I want to point out the context of the whole year. So I actually have two different maps here, and I'm going to kind of focus on the white one. This is going back to 1928, and it's calculated in a special way where each day of the week has to match the day of the week historically. So where we are right now, it's hard to see, there's a blue line. This is where we are right now. We are right up against a typical time where we see that February swoon. And from there, we kind of get our footing maybe in there or maybe in March. And then we get a launch in April, May, June, and a little bit of a summer doldrums, some rockiness in the late year. That's when we see October pick up in terms of volatility. But then you finally get that Santa Claus rally potentially at the end of the year. So despite the fact that we're actually at record highs or very near record highs right now, a little bit of caution is warranted. And I wanted to close with a little bit of good news here. This is also from Ryan Dietrich, and he just tweeted this yesterday. S&P 500 is about to be up more than 3% year to date on Valentine's Day. In fact, it's up 4% as of right now. Why does this matter? It happened 32 times, and the rest of the year was higher 30 of them. So that is 94% of the time, and maybe a little Valentine's present there for investors. Back to you.
Great Valentine's Day present indeed, Jared. Thank you so much. Appreciate it. Coming up, we're going to take a closer look at the health of the U.S. consumer following this morning's weaker than expected retail sales data. That's coming up next. Stick around for Catalysts. Consumer spending saw its biggest drop in over a year in January, falling 0.9%, well ahead of the 0.2% decline that was expected. Morning Consult's price sensitivity index reached a high of 16.7 for January. The higher the number here, the more sensitive consumers are for prices. Here to break down what this tells us about the health of the U.S. consumer, Sophia Baig, Morning Consult economist. Sophia, great to have you. So let's talk about this price sensitivity index, because this is why I wanted to bring you on the show, is to get a sense of how sensitive consumers are to this inflation. It's at a record high, your index, but 16.7, that's not all the way near 100. That seems like it could be worse. Put this number into context for me.
Sure. So I love this index because it gauges how consumers react to higher than expected prices. We've been tracking it since early 2022, right before inflation started to surge to those highs in mid 2022. And back then, for context, the number was just a few points above zero. So over the years, we've seen that tick up slightly more and more and more as consumers become more fatigued with higher prices. And the way it works is we ask consumers every month about various categories for goods and services that they may have purchased, if they considered purchasing it, and where they measure the price. Was it higher than expected? Was it lower than expected? And then what did they do? So when they walk away more, we take the difference between those shares. It's a little bit complicated of a calculation, but it's pretty intuitive. So when more people are walking away, then we actually have higher price sensitivity scores. And that's what we see today with a high price sensitivity score across many goods and services, the highest we've ever seen this January.
And talk to me about what we know about which areas consumers are making that decision to walk away in. Are there certain non-negotiables, I imagine, like groceries versus other potential kind of wants but not needs that consumers are more willing to walk away from?
Yeah, so for January, we saw kind of a broad-based increase, especially for several durable goods like household repairs, supplies, and exercise equipment, as well as various services that are discretionary, as you mentioned, vacation-related services, restaurants, etc. But groceries, we actually saw a decrease in price sensitivity, which sounds kind of counterintuitive when you think about egg prices, but it kind of makes sense also because groceries, as you mentioned, are something that are essential for people to purchase. They need to purchase them anyway, even if they are running into higher than expected prices. So as the consumers are running into higher than expected prices with eggs and other groceries, they're more likely to just have to deal with it. Whereas for vacations, they can make that trade-off and decide to not purchase the vacation package.
And how are consumers feeling about goods versus services inflation? Because we do know that goods inflation has been relatively sticky, and now we're starting to see services inflation picking up.
So services inflation has been that thorn in the side for the Federal Reserve, and it makes it difficult for consumers as well. Right after the pandemic, closures began to reopen, people really demanded those services and wanted to go on vacation, wanted to go out to eat. But now that the prices have been increasing more for services versus goods, consumers are feeling a little bit more fatigue there. And goods has been a big helper for consumers and for that top line inflation number. But we're starting to see that sort of reheat a little bit more, especially now. It could be even worse with the threat of their tariffs putting some upward pressure.
Yeah, we've certainly been talking about the policy impact this morning, but we've also been talking a lot about corporate earnings, and we're heading into Walmart earnings here coming up. Talk to me about what you know about consumers shifting to lower price retailers and how that could impact companies like Walmart.
Yeah, so we also have a substitutability index, and that has been heating up a little bit as well at the end of 2024. And we see that especially for lower income consumers. So we also see that for high income consumers. So sometimes when people shop at Whole Foods or maybe more expensive grocery outlets, they might substitute down to Walmart and decide to buy there instead. So that could be positive and bullish for Walmart. All
right, Sophia, we're going to leave it there. Thanks so much for joining us this morning. We appreciate it.
Thank you.
We are going to have all your markets action ahead right here on Yahoo Finance. So stick around. You're watching Catalysts. China is critical to Apple, both as a market and as a manufacturing hub. About 17% of Apple's revenue in 2024 came from the Greater China area. But the iPhone maker has been struggling recently in the region, and that's starting to concern investors. Apple's China revenue has been in decline for the past few quarters, and smartphone sales are to blame. During the fourth quarter, Apple's smartphone sales growth fell nearly 10% year over year, while the nation's other top 3 vendors saw double-digit growth. Improved trends in China could be huge for the iPhone maker, and headlines this week have indicated Apple is investing big in the China market, namely by bolstering its AI offerings. Morgan Stanley analyst Eric Woodring called that investment a critical catalyst for the company's competitive stance in China. It would also be welcome news as the country has struggled this year. Apple shares have had a tough start to 2025 as well. The company is one of the worst performers among the Mag 7 names to date. Ahead of its most recent earnings print, a strain of analysts downgraded the stock for fear on iPhone weakness. Currently, according to Yahoo Finance, roughly 60% of analysts on the street have a buy rating on the stock, much less the Mag 7 peers Microsoft or Amazon. Apple set its sights on bringing its AI features to China as early as this summer. According to a report from Bloomberg, the company will partner with Alibaba to help support the iPhone maker's push into the region. We've also got a project launch coming next week. Here to break it all down, Yahoo Finance's Dan Howley joining me now. Dan, what are you looking at here?
Yeah, Maddie, it's really interesting, the news coming from Bloomberg that Apple is working with Alibaba and Baidu on Apple Intelligence, rolling that out to ensure that they're able to capture more of the Chinese consumer that may have moved away to Android competitors because they already offer their own AI capabilities. And so, that's a big bet for Apple. To go ahead and rely on 2 third-party companies. They already do rely on third parties in China for certain operations related to their iCloud, but this is going to be powering their Apple Intelligence platform. And so, here in the US, they've partnered with ChatGPT, maker OpenAI, so you have ChatGPT on iPhones when Siri can't answer a question that's maybe very specific or just needs a little extra help. But they're also using their own on-device AI as well, and then they have their Apple Cloud Compute. Well, they will do some basically online AI through the cloud. Excuse me. In China, they're going to be using Alibaba and Baidu to do a lot of this, and so they're working very closely with them. It's going to be a tough balancing act though because they have to get this out. Again, their competitors are already rolling out or already have rolled out their own AI capabilities. They're slipping as far as iPhone sales go there year over year. The last quarter did not look good for them in the China region, and they missed on iPhone estimates as far as overall revenue goes. And so this is going to be a major step for them. I think the other major step, though, is you need to do something interesting with the iPhone at this point when it comes to the physical design, or at least some of the capabilities. This year they're expected to launch a thinner iPhone, but there's other things out there in China that are interesting, whether those are large screens, foldable display phones, things of that nature. So they need to really kind of do something. I think more than just keeping up with the Joneses, as they say, when it comes to the AI aspect.
And what's that product launch this week about?
So that's going to be reportedly the iPhone SE, and that's going to be basically an entry-level iPhone. The last one came out in 2022. This is 2025. So a 3-year gap is a pretty big deal. And that old phone had Touch ID on it, your classic home button. It's pretty outdated at this point. So this is expected to look similar to the iPhone 14. It would have likely a single camera, which, I mean, that's not that great when it comes to, entry-level phones. If you look at something like Google's Pixel or what Samsung has to offer with their entry-level devices, they offer more as far as camera capabilities. But the display is going to be an OLED display. And they're going to have USB-C, and importantly, it's also going to have Apple Intelligence. So it's starting to roll that capability out to more consumers at different levels. Right now, you can only get it if you have the iPhone 15 Pro or Pro Max or the iPhone 16. You can't get it on anything else. And so it's seen as critical to getting people to upgrade.
And 30 seconds left, Dan. TikTok has been brought back on U.S. app stores nearly a month after it was taken down over that possible ban. What's the latest there?
Yeah, I mean, look, I deleted TikTok before or after the ban was put in place, just making sure that I could see what would happen. I downloaded it again last night. Obviously, that more people are doing that. It's interesting that Apple and Google are taking this stance that they have gotten assurances seemingly from the White House that they won't face any charges or anything along those lines as a result of the ban. It's a big risk. They were the holdouts. They were the reason why people couldn't download the app itself. It was still operating, but I think this is a rather large risk, and they must have gotten pretty tight assurances that nothing bad will happen if the ban does go into place.
All right, Dan, got to leave it there. Thanks so much for joining us. We appreciate it. We're going to have all of your markets action ahead right here, so keep it here with Yahoo Finance. You're watching Catalysts. DOJ members readying a complete review of the Department of Defense that could come as soon as Friday. The DoD accounts for more than 12% of the federal budget, with a budget in excess of $800 billion, a level of spend President Trump says he wants to cut in half.
At some point, when things settle down, I'm going to meet with China, and I'm going to meet with Russia, in particular, those two, and I'm going to say there's no reason for us to be spending almost $1 trillion on military. We're going to have them spend a lot less money, and we're going to spend a lot less money.
Joining me now to discuss, Steve Simoni, CEO of Allen Control Systems, a defense company specializing in advanced robotics, having worked with security agencies and the DoD. The company is also backed by investors, including White House AI crypto czar David Sachs of Kraft, so we just want to mention that. But Steve, thank you for being here. Really interesting to have you on a day where we have so much news about the Defense Department. I'm just curious if you can give me a sense of how your business interplays with the Department of Defense and what defense spending looks like and how it impacts you.
Yeah, so thanks for having me on. We work very closely with the Department of Defense. We're bringing a new capability to them. It's an AI-powered machine gun. And so we're working with them to show them how this works and deliver it to them.
And what does that, just talk to me about that technology, because our audience can see some of it playing out on our screen here. What does that look like? What impact does that have on the Department of Defense's ability to cut spending?
Yeah, so what we're trying to do is change the battlefield economics. Right now, we're shooting down drones. Elon talks about this a lot with like $100,000 missiles, and the drones cost $1,000. So what we're trying to do is use an AI-powered machine gun which a bullet costs $1 to shoot them down. And so what the product does is it kind of scans the battlefield with computer vision, and then the gun can slew or move to the target and shoot it very quickly, which is something a human operator couldn't really do before. The drones move too fast.
I'm sure you know this as well as anyone, but I think people both love and fear AI. They love the idea of the cost cutting, but they're afraid of AI scanning and getting it wrong. How do you deal with that question?
Yeah, what we're trying to do is deliver the first safe autonomous guns to the battlefield. This is a very hard problem because these products are very powerful. And so it really takes a lot of operator training. We're trying to show the military this new type of capability and then show them how to safely operate it. And look, they're the professionals and they're the ones that are going to be actually using it on the battlefield. So they're actually doing a lot of stuff internally right now to leverage these products.
Something else the administration's really focused on, as you know, is border security. Can you talk to me about what innovation you're seeing in terms of security at the border and kind of the appetite for AI-powered technology?
Yeah, so at the border right now, there's trying to do all kinds of new things with computer vision to scan the skies because drones are everywhere. And drones are changing not just the battlefield, but they're changing border security. And so a lot of new products and services are going on to the border to help mitigate these threats. And so it's a very important time right now for that.
It is, and it's so interesting hearing these congressional hearings. You hear a wide array of commentary from Congress folks, those who seem to really get the technology and those who have a ways to go to understand it. How much appetite is there from Congress to really embrace AI?
I think there's actually a pretty large appetite right now. I mean, we heard J.D. Vance just speak about this at a big conference, but one of the things is that they're all looking for ways to save, cut costs and be more efficient. And so they're really interested in this right now.
And more broadly, just speaking about the business, you're not the only defense player in this space that's performing very well. A stock like Palantir that's public is something our audience of retail investors love. But you are private. Some others in the space, like Anduril, also still private companies. Why stay private? What's the benefit?
The reason you stay private is because you're trying to obviously build up your revenue and customer base before you're scrutinized by the public markets. So that's probably why. Right now, we're a much smaller company, and we're just growing pretty rapidly right now. So we'll be private for a little longer, but I have high hopes for the future.
What's demand looking like?
Demand's great. So all the branches of the services really want to get autonomous guns. Most guns right now are joystick controlled. And the drones are moved so fast and they're so dangerous that they need to find a way to neutralize them. So demand's looking great.
All right, Steve, we got to leave it there. Thank you for joining us.
Thank you for having me.
Really appreciate it. As we head to break, I want to check in on a software name focused on defense, Palantir. As I mentioned, that stock up more than 50% year to date and still running, as you can see, up over 1% in the trade today. I also do want to take a look at the major averages here because we still got stocks heading towards record highs. You've got the S&P now decidedly above that 6,000 level. You've got the NASDAQ up about 0.2%. Stocks coming in, though, from their highs of this morning, especially on the tech-heavy NASDAQ. We saw that up about 1% earlier in the trade, now up just about 0.2%. Finally, checking in on some names moving post-earnings. We've got AMAT, Applied Materials, still falling after trade tensions dented its near-term revenue forecast. Airbnb still moving to the upside, up over 15% on that stronger than expected fourth quarter report. And finally, Coinbase seeing revenue surging up 138% thanks to a crypto rally around the election. The stock is down about 6% in part due to that record run into their earnings print that left investors perhaps with the opportunity to do a bit of profit taking off the back of those stellar results from Coinbase this morning. Well, coming up, wealth dedicated to all of your personal finance needs. Brad Smith is going to be back to have you for the next hour, so stay tuned for more and have a great weekend.
It's time for Yahoo Finance's Market Minute. Stocks are mixed to end a busy week of shifting trade policy and mixed economic data. Shares of SoundHound AI, Serve Robotics, and ARM all lower on news that NVIDIA cut positions in the tech companies. An SEC filing shows the AI giant dissolved its stake in Serve and SoundHound while trimming ARM. Moderna reversing some of its pre-market losses, edging higher now. Shares initially plunged after its latest earnings report. One analyst saying the company, quote, could theoretically go out of business. Shares were briefly halted for volatility. And GameStop shares rising on a report the company is considering investing in crypto and other alternative assets. That's according to CNBC. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, investor guidance. There's a lot of headlines out there about potential tariff policy under President Trump, but I'll talk to one portfolio manager about how he's helping clients reduce their exposure to these headlines and focus a little less on their portfolio. And housing hurdles. We dive into the state of the housing market as mortgage rates continue to inch lower but remain well above 6%. Plus, it's the day of love. We discuss why Valentine's Day might feel a little bit more expensive this year. Plus, tips for couples managing their money. All that and much more coming up during today's show. But first, we take a look at some of the market action 90 minutes into the trading day. Stocks mixed today, trading near the flat line after a winning week. Investors still digesting global trade policies and inflation data. Joining me now, we've got Dan Ryan, who is the Sinceris Advisory Managing Partner. Dan, great to have you here in studio with us. Now, you say you're helping clients reduce the noise, so turn down the volume there, and actually recommend checking your portfolio a little less, a little more woosah perhaps. Walk us through this.
Sure, Brad. Thanks for having me. Of course, it's been an interesting month or so where we're all just adjusting to this new influx of constant media coverage, and we're pretending to relearn the lessons from Trump 1.0 and calling them Trump 2.0. And really, it's just an administration that's less about having a constant thesis and more about just occupying the conversation constantly. And for investors, that's really tricky when you have to go home and create a thesis for your own portfolio, when you're tuned into that on a daily basis. And so maybe they can adjust their behavior a little bit so that they're not so subjected to it.
Interesting. Okay, so as you think about everything, because of course our job is to cover what is being talked about from the administration, and there's so much, but what are you dialing up versus dialing back in terms of things that are impacting portfolios right now?
Sure, and so there's a little bit of just behavioral shifts, right? If there's an article and you don't have time to read it, don't read the headline, because there's an emotional component to that you're carrying around with you through the day. And maybe you have to turn off the notifications on your phone, which is a horrible way to consume content, and take some time to de-appify your world a little bit so that when you're making those decisions, you're really grounded in having the complete data set in front of you.
And so that's how to turn down. So what about when you finally have time to read into an article? What is the kind of next leg of research that you should be doing on top of it if you know there's a potential impact to one of your portfolio components?
Sure. So having a data set that you know has kind of a long-term outlook. And again, because so much is going to be short-term in nature. And the reality is you have to have some general sense of the market in that a pullback is likely in the next 4 years at some time. Maybe that's 10% or 20%, but the reality is it's going to come. And if you are spending every day doom scrolling and expecting that pullback, then when it does come, you're gonna have a tremendous confirmation bias, right? And you're gonna say, I knew this was coming. And that's gonna shade your decisions going forward.
In your notes to us, you said that big tech is undergoing a midlife crisis. Break that down for us.
Sure. So, big tech already bought the Porsche, right? It got its AI baby, and it's roded around for a little bit now. And now maybe it's time that it has to go home and deal with earnings. And we've seen a lot of this forward guidance starting to have this softening language in it of like, hey, we might be below expectations. So there might be some whipsaw effect here throughout the year.
I want to get some of your sector picks as well here. You like financials, utilities, healthcare. Rank them, and what are you expecting from these three?
Sure. So I'm going to do what an advisor does always when they don't have a better idea, and that's say we like high-quality stocks that pay a dividend. And so those are the major players there. I think first, financials, obviously. It has been a Trump trade with the potential deregulation. But more so than that, there's some really strong balance sheets and names out there that pay a dividend, maybe Goldman Sachs or JP Morgan. So that's probably top of our list. After that, again, utilities with the dividend component, we can all stare down the facing electricity need in the country. And so in that regard, there's some great names, maybe an Eversource or an AES there. And lastly, healthcare, there's less dividend-paying names, but we've seen things that do pay a dividend, like CVS is having a tremendous year already.
Interesting. Within those, and I know we're focusing in on sectors right now, but are there specific names within each of those sectors that you're a little bit more bullish on than others because of their own positioning right now?
Sure, yeah, absolutely. Like I said, Goldman Sachs, JP Morgan, those are great names. These are blue chips, and again, playing to the quality and just having a strong balance sheet, strong earnings. And certainly the energy names are a little bit more speculative. But again, it's not the energy that we all thought it was going to be. That's going to be drill, 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 and oil. It's also electricity.
Interesting. Dan, great to have you here in studio.
It's a pleasure. Thanks so much, Brad.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got market domination co-host Julie Hyman. Julie, great to see you.
Yeah, good to see you too.
First up here, let's talk a little bit about shares of SoundHound. We've been tracking this one this morning. SoundHound AI and Serve Robotics both falling after NVIDIA exited some positions in the companies. Yahoo Finance has reached out to both for comment here. ARM Holdings also falling on a reduced stake here. And so all of these things considered, NVIDIA also getting hit. They revealed positions of around $25 million in WeRide, $33 million in Nebius Group. Those shares are rising. So all of this because of some of the action NVIDIA is taking.
Yeah, exactly. And by the way, I reached out to NVIDIA for comment. They did not have a comment on these changes of their stakes. It's 13F season. And usually what 13F season means for us is that we're looking at big investment firms, right? And seeing what changes they make. But NVIDIA, because it has an investment portfolio, also has to file a 13F. So it's interesting to get some insight into what it is investing in. Now, wanted to sort of take these in two buckets, right? First of all, you have the trimming of the ARM stake, right? ARM, the big chip designer. And NVIDIA has a history with ARM, we should mention. At one point, NVIDIA was supposed to acquire ARM, and then they terminated that deal back in 2022. So there was also this sort of legacy investment in that company. So now NVIDIA is trimming that stake. They had about 1.1 million shares as of the end of the year. 2 million had been the third quarter filing. So a pretty big drop. They hold about 0.1%, though, of ARM shares outstanding. So just to give a little perspective, ARM, by the way, yesterday, if you recall, there was a report in the Financial Times that ARM was partnering with Meta to make chips. Now, ARM is primarily a sort of chip designer, and so the fact that it would be making more of the chip or responsible for more of the process was a big step for them. The stock went up, but it is a little bit lower today. When you're talking about a SoundHound AI, a Serve Robotics, these smaller companies that NVIDIA was investing in, it was sort of like a point of pride, a point of probably ability, something that helped them in the business to say, NVIDIA is invested in us. So it's quite interesting here that NVIDIA is now exiting its stakes in some of these companies. And, in some cases, they're small companies. They're already very volatile stocks, so maybe it had to do with that. We don't know. We can only speculate, but certainly there's an effect on those shares.
Right, a validation factor when you get those investments from an NVIDIA,
yes,
especially in this environment too. Let's also talk about Twilio while we have you. Twilio plunging after missing on first quarter profit guidance. The cloud company sees 88 to 93 cents a share. That is falling short of the 98 cents that was expected here. Shares right now, they're down by about 15, 16% here in trading.
Yeah, this is a software company that serves sort of communications purposes. And it seems like the company, they recently had an analyst day where they gave some targets. And it seemed as though some analysts were hoping for a little more update to guidance from today, more improvement in guidance from today, and they didn't get that. So Jefferies, for example, the analysts there saying there weren't any surprises following the analyst day, though the most optimistic investors, say Jefferies, were hoping for another upward revision to guidance. Put things in context here. This is a stock that's trading at about 35 times forward earnings. It's up about 70% over the past year, even with the decline that we're seeing today. So obviously there was some optimism that was baked in. One of the cool things that the company's doing that I noticed from their earnings call, if you call 1-800-CHAT-GPT, I guess it is Twilio is the vendor, like the software that's powering that call.
Yeah.
Kind of a cool thing.
That
right?
is.
But you know, not cool enough. I guess some investors already knew about that, but I just thought that was cool.
It's my first phone call after the show today.
1-800-CHAT-GPT.
Well, yeah.
Call it up. Well, apparently, like I think that was in part designed for people who are not very comfortable on computers, older people perhaps, who still would have access to AI and to a chatbot, like a generative AI.
Interesting.
Through that.
Okay.
I think that was the point of that thing.
All right, rotary phone the ChatGPT instead of dialing it up online.
Well, I'm proud of you that you know what a rotary phone is.
Oh, come on now. We had this. Julie, thanks so much. On a month-over-month basis, retail sales contracted nearly 1% in January after a strong holiday shopping season, the biggest drop in nearly 2 years. But is January's decline just seasonality at play or an indication of a slowdown among shoppers? Joining me now, we've got Sucharita Kodali, who is the Forrester Research Retail Analyst here. Sucharita, great to have you here and grab some insights as well, as always. Just take us into your thinking around this retail sales miss that we saw.
So these numbers are very deceptive, and I just encourage everybody to be extremely cautious in how you look at them, because what it is essentially the numbers from December to January that they are comparing. As an analyst, what I look at is January to January numbers. So when we're looking at year over year numbers, the numbers are actually incredibly strong. And we saw almost a 5% lift in this January versus January sales in 2024. And even when you normalize that for inflation, that is still growth. And that is part of the reason that the economy is still hot. Consumers are still spending. Spending on cars, as an example, is at a record high. Cars have virtually no inflation right now. So people are clearly spending on big ticket purchases, even in spite of higher interest rates. So I don't think that looking at the numbers, the month over month numbers, are all that interesting. Literally what it is they are comparing the change from December to January this year versus December to January last year. And of course, there's going to be some issues related to fires and floods and, kind of natural disasters. But if you're looking in the aggregate at the year over year numbers, they're incredibly strong.
And so I want to go further into your category analysis as well here, because on face value, we would see most categories declined on a month-over-month basis, but food and drinking services, they were an exception, rising nearly 1% from December. So what does that tell us about what consumers are prioritizing in their spending habits right now?
Well, they seem to be prioritizing just about everything because virtually every category has been growing this year versus last year. There were some larger big box type of general merchandise products like sporting goods and toys that are a little softer, but apparel is up, food is up, grocery stores are up, gas is up. Of course, automotive, as I'd mentioned, is up. So almost every category is doing well. Now, one highlight that I did think was interesting that was softer than I've ever recalled seeing it is non-store retailers. And that is essentially e-commerce and all of the online purchases that we've historically been doing. Now that suggests, are we hitting a wall with respect to e-commerce penetration? Possibly. Are people just going back to stores and purchasing in physical stores? And that's likely, well, that's definitely what we're seeing. Is that a permanent trend? Is that something that sort of has sort of stabilized the shift from offline to online? I think we may be seeing it right now.
And so with all these things in mind, there were some, of course, larger factors that we have yet to see the full impacts from, everything from natural disasters to even larger employment shifts as well. You know, how are you running the calculus early on around what those events actually might hold for future readings?
The impact of those one-time events is often regional, particularly when we're talking about natural disasters. They tend to be regional. They tend to affect certain retailers and certain types of stores in certain regions. And generally, they are not long-term effects because you generally see a rebound. It's not unlike a culture war issue that may impact a retailer in a given quarter, but typically there's a rebound or a privacy crisis or some sort of a data breach. It's similar in those ways. Now, when we're talking about unemployment or some of the macro factors, there are other usually exogenous factors, like the dollar channel, for instance. In spite of the economy doing pretty well, usually you would expect a company that is competing on price and value to do very well. But though that channel has other reasons, like for instance, the over diversification of their stores, they grew too fast over the last few years. So we're normalizing a bit of that behavior. But it's for the most part, I don't usually incorporate these one-time events into, you know, kind of assuming that that's going to have an impact for years and years to come.
Sucharita, always a pleasure to get some of your insights in time. Thank you so much.
Thank you.
Coming up, everyone, we have more on the state of the consumer. I'll talk to Jason Robbins, who is the CEO of DraftKings, about their fourth quarter results and the outlook for sports betting in 2025. Stay tuned. DraftKings shares are higher after fourth quarter earnings came in better than investors feared. The sportsbook increasing the low end of its full year revenue outlook. Revenue in Q4 is in line with estimates, but up 13% from the year prior. Monthly unique payers was a highlight, up 37% from the prior year. Here to dive into the results, we've got Jason Robbins, CEO of DraftKings. Jason, good to have you here with us. No doubt there is season over season, sport over sport, year over year. There's just more of a focus around fandom annexation to wagering as well. What have you seen in the propensity of fans to, annex some of their viewing to also wagers as well?
Well, I think that, this is a secular tailwind. As time goes on, I think that more and more people are going to be interested in it. We also are seeing that in the numbers. Customer acquisition last year was absolutely phenomenal. It was way better than what we expected going into the year. And I think that's really what set us up for such a strong forecast in 2025.
I know we're talking about a quarter that you've closed the books on, but I have to think about this most recent Super Bowl that we've just come off of, and given the viewership setting records that we saw, how that translated through to some of the current quarter successes for DraftKings.
Well, the Super Bowl is also just a huge day for us. It's always our most important day of the year, but this year it was bigger than ever. We had we disclosed we had $436 million in handle, which shattered our previous record, and we also had a really good set of outcomes too with Saquon Barkley. Sorry, I know it was his birthday. His team won, so I'm sure he's not too unhappy, but him not scoring a touchdown definitely was helpful because that busted up a lot of the parlays. So really a great day, and that's led into a strong last week since then. I mean, NBA is on fire right now after a little bit of a slow start, so really excited to see the momentum.
I wonder what type of growth you're tracking in parlays, as you had mentioned. And yes, I am very glad that the Eagles won the Super Bowl as a native Philadelphian. I have to think about, though, yeah, I wish I was at the parade today, but this is a close second here, Jason, so I'm appreciative of the time. As you're thinking about the amount of parlay wagers that you're seeing, what is the growth profile that you've witnessed there?
Well, we mentioned in our earnings call today that we had seen a 40% year-over-year increase in same-game parlay handle on the Super Bowl. So that was a really big deal for us. We talked earlier in the year about 500 to 600 basis points improvement in bet mix, and that's continued to trend up. Also been a really strong start to NBA season too from a bet mix perspective. I guess it's not the start anymore, but strong first half of the season. So great to see that. I think as we improve those product offerings and as more players give them a shot and love them, we expect that to continue.
So we're also looking across the states, and we were having a conversation with one of your competitors leading up to the Super Bowl, and just getting a sense, would love to get a sense of how you are advancing talks, discussions, approvals within those states where there's a massive opportunity, but there could also be some huge customer acquisition costs as everybody vies for that platform attention here, thinking about California and Texas.
Well, those are obviously two tricky ones. They're the big ones, so it's certainly a point of focus. But as any big state, there's a lot of complexity. So, we think over time, almost all the states will end up having online betting. It just feels like at some point that's inevitable. But, who knows what the timeline is for those two, because in each case, there's individual reasons that they've been held up that, at least at this point, I don't think necessarily have a clear path. So we'll find out as time goes on what the pace for those two are, but I do think that it is inevitable that at some point, it's hard to imagine California being one of the only states in the nation not to have legal online sports betting. So I have to think at some point it's going to happen.
Jason, we hear other tech companies talk about, in Meta's case, it's going to be the year of the metaverse, or in Robinhood's case, the year of tokenization being a huge opportunity. What is this the year of for DraftKings?
Well, I think this is the year for in-game betting for DraftKings. We are really making a bigger investment there. I think it's a huge growth opportunity for us, and also something that can really enhance the experience for fans. So I think that's a big deal for us this year. And there's a lot of things we're focused on, but if you're asking me to give you one, that would probably be it.
And so as you think about the kind of trajectory and what type of investments need to be made in order to continue scaling up the business here, how are you looking across some of those expenditures and making sure that that scale is happening at the pace that investors are expecting as well?
Well, we've said we don't expect to see, more than very modest growth in OpEx this year. We made some acquisitions last year that bolstered our live betting capabilities, namely Simple Bet, Mustard, and Sports IQ, as well as our overall sports betting capabilities. So we feel like those are really what's going to set us up for this year. And, we'll always continue to invest in key areas like machine learning and engineering. But, I do think that we feel pretty good about where we're at. And I also think there's efficiency to be gained from getting more AI and more types of automation implemented at the company. So there's a lot of, I think, good tailwind there too.
All right, stocks up about 44% year to date. Good start to 2025. Jason, would love to check back in the future. Appreciate it.
Thanks for having me.
Coming up, everyone, the 30-year fixed rate mortgage, it's falling again last week. We'll discuss what it means about the state of the housing market. Stay tuned. Mortgage rates for the week ending February 13th are out. Yahoo Finance's Claire Boston joins me now with the numbers. Hey, Claire.
Hi, Brad. So this week, the 30-year mortgage rate is at 6.87%. That is down slightly from 6.89% last week. 15-year mortgages are at 6.09%, and that is up slightly from 6.05% last week. So a little bit of a confusing week here with the data, and I think that really reflects the volatility we are seeing overall in the bond market these days. Bond yields really closely affect what mortgage rates do, and it's been a pretty choppy time, and so we're kind of seeing that in the rates this week.
Yeah, the chief economist for Freddie Mac saying this is reaching its lowest level thus far in 2025 for the 30-year fixed rate mortgage. We are early innings in 2025, but also recent mortgage rate stability, they say, is benefiting potential buyers. Purchase demand stronger than this time last year, indication that a thaw in buyer activity could be on the horizon here potentially?
Right. So we have seen a little bit of good news, but one thing to note is mortgage rates have been in this very narrow range so far this year. The highest they've been is about 7.04%. So it's still an elevated environment, and a lot of people that I speak to say, we may be stuck in this slightly higher period for longer. Factors like CPI data that we saw on Wednesday really point to the Fed not being able to lower interest rates really fast. That all kind of flows into where mortgage rates are.
All right, just to recap the numbers here, 30-year fixed rate mortgage averaging 6.87%, slight 2 basis point move lower from last week. And then additionally here, the 15-year fixed rate mortgage, 6.09%. Just a little bit higher from last week by 4 basis points. Claire, thanks so much.
Thank you.
Although the 30-year fixed rate mortgage fell to the lowest level so far this year, it's still stuck in a relatively narrow bound band just below 7%. And many experts say that we may be stuck with these levels as financial markets whipsaw in reaction to fresh economic data and new policy decisions from President Trump. So here to talk about potential catalysts for the housing market, we have Lawrence Yun, who is the chief economist for the National Association of Realtors. Great to have you here with us on this day, Lawrence. Just want to get your read in, especially as there wasn't much movement, but as we're kind of in this range-bound territory, what that might do to the psyche of potential home buyers and those who are listing their homes.
Well, Brad, thanks for having me. And the mortgage rate, as you said, has been in this narrow range, high 6%, almost touching 7%. But the interesting development is that we are beginning to see more homes on the market. Inventory levels in the autumn of last year and in January rising above what it was 1 year ago. And consequently, we have had 3 straight months of rising home sales, despite no movement in mortgage rate or even higher mortgage rate condition. This is indicating that consumers simply want to see more choices out there, and they are beginning to see that. And consequently, even at this elevated mortgage rates, they are making decision to buy.
And so what we've also seen as part of this dynamic is those who have listed their homes, they're trying to run the calculus around if it's looking like a stale listing, whether or not they should be pulling their listing right now. What are you seeing play out?
Well, in the winter months, the number of delistings began to rise. Simply that people who wanted to sell by the end of summer, by end of August, if it did not occur, then homes would be lingering through the autumn months, winter months, and it doesn't, they want to give it a fresh start. So usually after the listing, more shows up in the spring months. So consumers, be on alert for more choices, say from March, April time period, and especially with possibly mortgage rate, which has been sort of stuck. If it moves a little downward, one can expect even more rush of buyers trying to come into the market.
What we had heard from Freddie Mac's chief economist was that there might be an indication that a thaw in buyer activity could be on the horizon. Does that thaw in buyer activity that they're anticipating benefit existing homes or benefit the new home side?
Well, the new home market has actually grown in 2023 and 2024, 2 straight years of rise in new home sales. And the reasoning for that is more inventory. Builders are in a position to create inventory. They have about 8 months of supply of inventory. One may say a little too high, but even with the discounting prices or say mortgage offering buy down in mortgage rates condition, the builders are still turning profit. So as we see more inventory in the existing home market, this will bring about more abundant choices because existing home market is the dominant market, generally about 90% of the market. So thawing out in the housing market, which have been frozen in terms of home sales lowest in 30 years, with more buyers, more sellers, this is going to be a great market condition for both buyers and sellers in 2025.
Lawrence, I want to get some actionable tips for folks who are gassing up the car or perhaps just getting their walking shoes on, ready to go door to door, or perhaps have their listings already ironed out and going to go house hunting this weekend. What should they be keeping in mind?
First, make sure that one do not overstretch their budget. No need to waste time visiting homes that is outside of their budget. But as they are viewing the open houses, one thing to note is, are there other buyers also entering the home? And take a note of that because we are still in inventory shortage condition. Even with rise in inventory, I would say we need additional 30% growth in inventory to get us back to normal. So just check out potential buyer competition, and if that is the case, how one wants to make an offer, little above price, at the price, or how much discount are they willing to put in. Naturally, if there are no other buyers, at least visually, then one could try to negotiate for something a little better.
Lawrence, thanks so much. Appreciate it as always.
Thank you.
Most Americans procrastinate on their taxes, with 24% filing in April and 22% waiting until the absolute last minute, according to a survey. So once you finally get your taxes done and get your refund, what should you be doing with that money? Joining me now with some tips, we've got Ross Mack, host of the Financial Freestyle podcast here. What should we be doing with that money?
I love the question. I think we always have to start off by saying, what is a tax refund? I think it's a misconception that it's like, oh, the government is just giving me a bonus check. That's actually not the case, right? The tax refund is it's actually your money, and the reality is you were overpaying the government the prior year. So you have to look at this and say, okay, I was giving the government an interest-free loan the prior year, and now they're just giving it back to me. So moving forward, you obviously want to look at that and potentially see, how to adjust that if there are new withdrawals. But if you do get a tax refund, right, so now that you know it's your money anyway, don't just look at it as a bonus. Let's actually do something and be responsible with it. So first step, I always recommend, you got to pay down debt. You have to pay down, especially that high interest credit card debt, right? We're talking 10, 20, sometimes 30% interest, and I think it's very important that you pay that down. And then next, right, if you don't have any credit card debt, or if you paid that down and you still have money left over, let's build up that emergency fund. I think it's important that you have a fully funded emergency fund, and we're defining that by 3 to 6 months of your necessary expenses. And then now, let's start putting that money to work for you, right? Let's talk about investing. We could look at, Roth IRAs, right? But when it's all said and done, where are you putting that money? I recommend the first form of investment, very diversified, the S&P 500. And then, like I said, you want to keep going down ways of allowing that money to work for you. So whether that is funding your children's college fund, whether that is putting, money aside for a down payment on a home, starting a new business, the list goes on. But I do want people to be responsible, because guess what? That was your money anyway. It wasn't just the government saying, hey, oh, by the way, here you go, just for existing, here's some money. Like, no, it was actually your money in the first place.
Yeah, the annual, it's my money and I need it now. Give it back to me. Ross, thanks so much for taking the time.
Absolutely.
If you want to see more from Ross, check out the Financial Freestyle podcast every Monday, 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. There you see him right there on the screen. Coming up, did you know that it costs you an extra $1,800 a year if you're living from paycheck to paycheck? We're breaking down why and how to avoid some of those extra charges after the break. Cash poor Americans, aka those living paycheck to paycheck, pay over $1,800 a year in unplanned expenses. That's according to the 2025 Cash Poor report from Solo Funds. And those numbers are even higher for Black Americans. Joining me now to break down why and offer a few ways to change that, because we want some answers here. We've got Rodney Williams, who's the Solo co-founder and president. Rodney, great to have you here in studio with us.
It's great to be here.
So let's discuss this a little bit more. What are the unexpected expenses behind some of these costs?
There are things like the flat tire on the way to work, or the unexplained or the unplanned medical bill. You'd be surprised about how many Americans have pets, and when a pet gets sick, that's a bill that they did not plan. So these unplanned expenses are about 4.8 per year that the average consumer will experience.
And so the disproportionate effect that we're seeing among different ethnic groups, and especially among Black Americans, what have you been able to identify there?
19% of Black Americans feel uncomfortable about paying a planned expense. So you can only imagine what happens when it's unplanned. And I think that uncertainty stems from the limited cash. So in our research, they tend to run to credit cards at a significantly faster rate than our white counterparts. So, and that's 46% versus 42% actually use a credit card when it relates to an emergency expense.
So what are some of the tips for people who are living paycheck to paycheck and want to do better about saving, do better about expense planning as well, and perhaps create some breathing room?
Yeah, I think that there's some tips. You know, unfortunately, the cost of living in certain cities like New York City is really difficult. So if you're a school teacher, if you're a police officer, if you're a fireman, it's really difficult to manage. I think the best thing you can do is think about total costs. So when you think about your choices for credit, think about the total costs of all scenarios. I think the second thing is look for alternative options. Financial technology companies have some great options, obviously Solo Funds, but I would tell you buy now, pay later, or things outside of the credit card, based on our report, actually are cheaper and more affordable for Americans.
So how can we close the racial wealth gap? Because there are, so many different initiatives that we've seen put forward, and some of them being redacted now on a government basis or even on a corporate basis. But how can that still be a change that we're all doing our part to make sure narrows that wealth gap and perhaps one day finally eradicates it?
I like to explain this question. I'm really passionate about this question. When you think about closing the wealth gap, your personal wealth needs to grow every year. And it needs to grow proportionate to the rest of the market. That's about 20%. So when you think about how do you save 20% more each and every year, that's kind of the mindset that I would like to break it down. I know you hear things like owning a home or investing. Just think about simply increasing your worth and your savings 20% every year, and that's the start.
Shifting gears here, you are a founder, businessman. We got to get your advice for other people, because people are trying to extrapolate as much as they can from their margins, or extract as much as they can from the margins of their time, investing in themselves and building up potentially new career opportunities. And we all hear about these streams of income. What's your advice to people who are working outside the traditional 9-to-5 in order to do that and advance themselves?
Consistency is key. You're not going to know everything. You're not going to have all the answers. You're not going to have all the support. But I believe that consistency actually proves really well. Be organized. There's so many mistakes that you can make by just being organized. And I always say my final thing is focus on the daily wins that you have. Things are going to go bad. But if you kind of think about building a house, don't think about the house. Brick by brick by brick. And I think that's pretty important. Daily wins is what I celebrate.
What are your leadership lessons for the next generation of entrepreneurs who see the successes? We were talking about Culture House. You have so many different, we'll say, kind of initiatives and businesses, and that you could even forget about them on any given day. So how do you make sure that the next generation is well equipped?
Yeah, my message is clear, and I think it's clear in moments like this. It's find things that you want to do, that you would do no matter what, and I call that purpose. Lead, build, and innovate with purpose. When you build and do things with purpose, success feels different. It's not just about the monetary value. I'm always about consistency and perseverance. I don't necessarily talk the best, or I don't always have the right things to say, but I'm always going to show up, and I'm going to stay there to the end, and I'm going to try my best. I also think balance is a luxury. I know we love soft life, but balance is a luxury. right? Survival is a necessity.
Yeah.
And most of us, like myself, I have to survive first, and then I have to find balance later.
Rodney, great advice. We appreciate the time here on Yahoo Finance with us.
Awesome, thank you.
Certainly. Before we go to break, this Black History Month, we celebrate the power brokers in business, the executives, the entrepreneurs, and proven change makers who have advanced economy and society. Golf hasn't always been the most inviting sport for Black Americans, but over time, key figures persisted and found a way to change the game. Dr. George Grant invented the golf tee. Charlie Sifford broke the PGA Tour color barrier. Althea Gibson doing the same on the LPGA, all paving the way for Tiger Woods, who has become the most decorated and instrumental force to ever play the game. Now, Earl Cooper and Olajuwon Ajanaku are driving representation in golf apparel through Eastside Golf. The business was founded just 5 years ago with the goal of driving cultural change in the game of golf and have already landed partnerships with, get this, the likes of brands like Nike, Bridgestone, and Mercedes-Benz USA. Cooper joined us on Yahoo Finance in 2024 and offered this advice.
I think there were several pivotal moments. You know, obviously the brand was founded by my business partner, Olajuwon Ajanaku. We played together back at Morehouse College, and he created the logo, and it was essentially himself. But I think for us, that moment when Michael Jordan said, you two have two amazing stories. We tell the best stories. Did we sign them yet? That's when it was just like, here's someone that, again, chooses his words, and for those words to have such an impact on us. And it just gave us such a vote of confidence, and since then we haven't looked back.
Coming up, everyone, it is Valentine's Day. We want to make sure your financial life isn't hurting your love life. That's next. And our next guest is going to have some tips on increasing your financial compatibility this Valentine's Day. A programming note, on today's episode of Warrior Money, Patrick and Dan speak to the CEO and COO of Parlay Finance about how they're revolutionizing small business lending through innovative AI and real-time data.
You come to the US, you don't have a background or a credit score even, and suddenly you're trying to apply for a loan. As a new business owner, it is so difficult. And so we said, we cannot let this stand. We need to make it easier for small businesses. We need to help them. And that's how we ended up founding Parlay. And we now partner with credit unions and banks across the country to do that and help more small businesses.
You can catch new episodes of Warrior Money every Friday at 12:30 p.m. Eastern on Yahoo Finance or wherever you get your podcasts. It's Valentine's Day, and whether you've had a dinner reservation booked for months or are stopping to pick up flowers and chocolates on your way home tonight, you're probably paying more than you did last year. According to the National Retail Federation, more than half of consumers are planning to give candy, while 40% will be buying flowers. Greeting cards, a night out on the town, and jewelry round out the top 5 as well. Most of those categories are more expensive this year than last year, with food away from home and candy both over 5% more expensive than a year ago. So you might want to pop a bottle of champagne and make it dinner at home. Those categories are less than 2% more expensive. One bright spot: jewelry prices fell nearly 2% from a year ago. But mailing a Valentine's Day card will cost you over 7.5% more than it did in 2024. And with cocoa prices over 70% higher than a year ago, you may want to go for the conversation hearts instead of a box of chocolates. 39% of couples who live together completely combine their finances, according to a report by Bankrate. And money is the primary reason for fights in 40% of long-term relationships. So, how do you avoid these scuffles? Joining me now, we've got Vanessa Welch. She is the Vice President for Financial Insights at Empower. Great to have you here with us. First, should couples be combining finances?
Well, no, this is a very personal decision if you're going to combine your finances or if you're going to split things up. If you do decide to split things up and not combine your finances, I think you need to have a yours, theirs, and an ours so that you're constantly working towards something together and you have that one shared goal.
So you also have to, I guess, think about what the yours, the ours, and mine is at the end of the day. And is there a good rule of thumb for how you've seen couples navigate that?
Well, really, Brad, the number one thing is to start the conversation. You have to start having these conversations with your partner about your finances. A lot of people get so frustrated that they just stop talking about finances altogether. That's going to make things worse. Here's what works. I want you to take an hour, maybe it's a Saturday while you're having coffee, and take a deep dive into your spending, into your saving, and then set a budget. My husband and I went through our budget line by line just a couple of weeks ago, and we found some areas where we could cut back, some subscriptions that we weren't even using. And then we set some goals for things that we want to save for as a family this year. And Brad, if I'm being completely honest, I was dreading this exercise, but after we did it, it felt really, really good to have a plan in place.
All right, sigh of relief. And those phantom subscriptions, my gosh, they scare me at every
Right?
turn. You also say to make a game plan for debt. What's your payoff strategy, and do you recommend joining forces to pay off one person's debt?
Yeah, I definitely think you've got to join forces. You've got to come together as a team to tackle that debt. I encourage people to do what I call the debt detox. And that's when you list all of your debts on paper by amount, by interest rate, and also monthly payment. Then you got to come up with a plan as a team to tackle that debt together. I like the debt avalanche method. That's when you're making the minimum payments on all of your cards, but you're also taking any extra cash that you have and you're putting that towards the highest interest rate debt. Once that's paid off, you're going to transfer that into the next highest interest rate, and so forth and so on until that debt's paid off. And Brad, it may be ugly, maybe a little bit messy to put all of that out on paper at first, but it's going to give you a roadmap and the confidence that you need to get that debt paid off as a team.
All right, the third tip here: set shared financial goals. Break that one down for us.
Yeah, this is where it gets really exciting because studies show couples who have shared financial goals are twice as likely to have a great partnership. And here's why. When you're working towards a shared financial goal together, whether it's saving for retirement, maybe you're saving for a down payment on a house or a big vacation, it can often bring you closer because you're encouraging each other along the way, and you're also holding each other accountable if one of you is tempted to get off track.
You also say to assign responsibilities for managing finances. So how do you determine who does what task?
Well, this is where you really have to play to your strengths. Usually there's a saver and a spender in the house. In our household, I'm the spender. My husband's the saver. Thankfully, he helps keep me on track. But when you can play to your strengths and really divide and conquer, I think it makes managing your finances so much easier. My husband's also very detail oriented. So he makes our monthly bills payments every single month. I'm a big picture person. So I set the monthly schedule for us. I set the overview and what we're striving to hit. And I I think that when you can separate those and play to your strengths, it really makes an impact. Now, if you can't come to an agreement, it may be time to bring in a financial professional. At Empower, advice is at the center of everything we do. We feel so strongly about the power of advice, no matter where you are on that financial journey. And sometimes bringing in that neutral third party can really get you on a solid plan. And oftentimes it can help you reach those financial goals a lot faster.
You know, I got to hustle to my finish here, but finally, you say set the next date. How often should couples be checking in on their finances?
This is up to you. Maybe it's once a month for some couples, every other week for others. But the important thing here is you have to set the date in your calendar, in your phone, just like you would any other meeting, important meeting, business meeting. I also want to encourage folks to change the way that you're thinking about these meetings. I don't know a lot of us who really like going to the gym, but I think that we would all agree after we get finished with that workout, we feel really good and we're glad that we did it. These meetings are going to be the same way. So think of it that way. And Brad, I'm not going to encourage anyone to do this on Valentine's Day. Let's celebrate tonight. Let's have the nice dinner and the roses and the chocolates. But once tomorrow gets, you really should start setting these really important financial checkup calendars in your phone to make sure that you have them.
Okay, I agree with that. Vanessa, thank you so much.
Thanks for having me. Happy Valentine's.
Same to you. Let's do a final check of the markets as we're taking a look at the major averages right now. We are mixed. The Dow is down by about 0.2%. S&P 500 flat but to the upside. NASDAQ is in positive territory by 0.1%. And that's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. Guess what? You can stay tuned for Market Domination. That comes up 3 p.m. Eastern Time. They'll count you down to and through the market close. Happy Valentine's Day.
It's time for Yahoo Finance's Market Minute. Stocks wavering. The S&P 500 eyeing a record high close to cap a busy week. Nvidia revealed positions in Chinese self-driving company WeRide and AI infrastructure company Nebius Group, sending shares of both companies surging. The chip giant disclosing a position of 1.7 million shares in WeRide and 1.2 million in Nebius. Roku shares popping after a strong earnings print. The company announcing it added over 4 million new streamers in its latest quarter and is on track to hit 100 million in the next year. Airbnb shares surging on news it's investing $250 million in a new business it says could be like Amazon for travel. The CEO explaining it would be, quote, one place to go for all of your traveling and living needs. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.